The broadcast is now starting. All attendees are in listen-only mode.
Good morning, everyone, and welcome to our webinar, Creating Your SBIR STTR Phase 1 Cost Proposal. I'm Rebecca Todd, your moderator this morning, and I work as Innovation Specialist for the Arkansas Small Business and Technology Development Center. We are taxpayer-funded to provide confidential one-on-one consulting, training, and market research services for entrepreneurs and established companies across the state. We've been working in Arkansas for over 40 years. We have 9 regional offices that allow us to help entrepreneurs and companies where they're at. We have 2 offices set to open later this year, which will bring us up to 11 total. Through our center's competitively awarded federal and state technology grants, the ASBTDC is able to offer continued outreach through events like this webinar to share information about the SBIR STTR program for statewide and national audiences. We help entrepreneurs with each step of preparing and submitting Small Business Innovation Research, or SBIR, and Small Business Technology Transfer, STTR, proposal applications, as well as state-level ones for supplemental technology commercialization funds. To date, our clients have won over 70 SBIR STTR awards across the participating agencies. Through our industry database subscriptions, we are able to locate market data to help our clients prepare key sections of their proposals, such as a commercialization plan. Everyone who registered for today's event will be receiving a copy of the slides, as well as a link to the recording within 2 days via GoToWebinar email. Some of you likely already received those slides yesterday. Arkansas-based attendees that are here today also have the option to meet with Jim next Thursday, June 3rd, for one-on-one sessions to review cost proposal drafts, indirect rate estimations, or other draft items regarding their cost proposals. So in the chat, I've put a message to this effect. Please reach out to me if you're interested at that email address. And before we get started, let's take a moment to make sure that everyone is ready and familiar with how to use GoToWebinar. So first, you should have a control panel in the right side of your screen. You can minimize this panel by clicking on that orange arrow button, which is in the upper left corner. You can expand the panel by clicking on that same button. So take a moment to practice. And second, you have the ability to submit questions using the question pane. This is near the bottom of the control panel. And I'll be taking questions throughout, and as we get to a particular slide where you might have a question or concern, please feel free to type in your question. I'll read that out to Jim so we can have a chance to get those answered for you as we go through today's presentation. So before we go any further, I want to go ahead and introduce today's speaker, Jim Greenwood. Jim Greenwood and his wife, Gail, have been involved in the SBIR program since its inception in 1983. The Greenwoods have taught SBIR STTR workshops in 48 states, plus Puerto Rico and Washington, D.C., offering training through local and regional economic development groups, universities, federal laboratories, SBDCs, and MEPs. The Greenwoods also have taught at many of the national SBIR conferences in the past decade. They are recipients of the coveted Tibbetts Award, based on their contributions to SBIR STTR outreach and education efforts. And they were also recognized by the Small Business Technology Council as champions for small business for their outreach efforts during the latest SBIR STTR program's reauthorization effort. Jim Greenwood has served as a commercialization reviewer for the National Science Foundation's SBIR STTR programs, and he's a coach for applicants that are participating in the Department of Energy's Phase 0 program for newcomers to SBIR STTR. So without further ado, I will now turn the presentation over to Jim. Take it away, Jim.
Thank you, Rebecca, and good morning, everyone. Thanks for joining us. Glad that you're up bright and early and ready to go. I'm sure some of you are sitting there with your maybe second cup of coffee going, now, why did I sign up for this webinar? This thing's about accounting. I signed up for an accounting webinar. Well, yeah, in a moment of wisdom, you probably said, you know, the cost proposal is something in an SBIR STTR proposal that maybe I'm not so good at, and maybe I've kind of had to make up my budgets, and maybe it doesn't seem to be that we're covering all of our costs when we get one of these awards. Yeah, see, that's why you need to pay attention to the cost proposal, because this is a part of the SBIR STTR program that people don't tend to spend a lot of time on, but it will eat your lunch. You will lose money. You will get terribly frustrated if you don't get some of the cost concepts down and really understand how to do the cost proposal. Give you a quick example. Years ago, there was a phase 2 sample SBIR proposal on the National Institutes of Health, NIH website. And it didn't have a lot of detail to it. It had a little bit of budgetary information to it. So one day I just kind of went down through the budget based on just, again, what they presented, not any of their books or anything. And they were asking for $1.2 million for this phase 2. We found almost $400,000 in errors in their budget. $400,000 in errors in a $1.2 million budget. Now, I don't know about you guys, but if for every $1.2 million in revenue that we generated or business that we generated, we screwed up $400,000 of it, we wouldn't be in business very long. So you got to get this stuff right. You need to do it well. Now, having said that, it's one of the more baffling things you're ever going to have to deal with in SBIR, STTR, because it's part of the federal bureaucracy and procurement system. But my goal today, in a measly 3.5 hours, is to kind of teach you about this accounting system, the cost proposal, some of the confusing terminology that you probably have heard thrown around, and actually teach you how to derive your own indirect rate and use it in a cost proposal. Now, if you're scratching your head going, what's an indirect rate? Don't worry about it. We're going to cover it. That's part of the workshop today. All right. Now, as you can tell, my other goal today is to make cost proposals and government accounting, if not entertaining, at least tolerable, okay? I mean, I could be real dry. I don't have a white shirt on, but I could do my accountant thing and just kind of drone on through all this stuff and talk all the jargon and probably put you to sleep within the first few minutes. But instead, I realize it's not an exciting subject, although a very important subject, and therefore I'm going to try to keep this as lively as possible as we go along. Now, kind of the layout of the day, we kind of have gone through the welcome and introduction. We're going to then talk about some basic government accounting concepts. Don't worry, I'm not going to talk debits and credits, but we're going to talk about things like direct versus indirect and allowability. We'll then turn to something called the FAR. You probably have heard the term FAR. You'll see it referenced frequently in the SBIR solicitations. The FAR is the Federal Acquisition Regulation. It's about the size of a medium-sized city phone book, tissue-thin paper, and probably about a 6-point font. And the FAR includes some, not all, but some of the thousands of rules that pertain to government procurement. And you're, of course, supposed to know all of it. So I'm going to cover the entire thing in 15 minutes. That means I'm going to be reading really fast. No, I'm just going to hit some highlights, and then I'll give you the opportunity to go out and delve into the FAR if you really want to. Then we'll talk format of the SBIR STTR cost proposal, kind of, what are the main parts that go into it. And what I want to really focus on there is a concept that you're going to learn a lot about today called allowability. Is this particular cost that you want to be reimbursed for, is it allowed by the federal government? Is it unallowed by the federal government? Or, as in most cases, is it allowed in certain circumstances and not allowed in others? We'll then kind of shift gears and talk about keeping track of expenses. Now, this means, you got an award, what do you got to do? My wife and I were teaching this workshop in the Dakotas years ago, and I remember a lady raising her hand. She said, so which set of books am I supposed to show the government? Well, you're not supposed to keep sets of books. You're supposed to have a set of books in terms of your accounting books. But we'll talk about kind of what you need to be tracking and putting into those books as you get your award and start working on the project. Cost proposal formats for various SBIR, STTR agencies. Believe it or not, when I first developed this workshop, I had all formats for all 11 SBIR agencies and all 5 STTR agencies, and I went through them one by one. For some reason, people found that boring. In fact, when I do the full day version of this workshop, that appears right after lunch. People were dozing off like crazy. So now what we're going to do in our abbreviated session today, I'm just going to hit the 3 big ones. I'm going to hit the one for Department of Defense, I'm going to hit the one for National Science Foundation, and I'm going to hit the one for it's grants.gov, which will cover NIH, Department of Energy, and USDA. Then towards the end of the webinar, we're going to do some exercise. Now, you guys be thinking about what you want to do. You want to do push-ups, you want to do jumping jacks, whatever you want to do. You know, while you're jumping up and down, I'm going to lead you through an exercise in which a fictitious little 4-person company prepares its first SBIR cost proposal. And a big part of that exercise is going to be that small company estimating its indirect rate for the first time. And my goal, by showing you how that little company would do it, I'm going to encourage you to follow that same path and estimate your indirect rate for your company so that you can start using it in your cost proposals. And then finally, we always want to end on a high note, right? So let's end with a discussion about audits. Everybody loves audits, right? Yeah, you get home at night and you're thumbing through the mail and there's that real thin envelope from the IRS. Oh boy, guys, sure hope it's an audit. I'd love to have an audit. I'd love seeing the IRS. No, of course not. Nobody likes audits. Everybody hates audits. But audits are part of SBIR STTR. So you got to be ready for them. Now, it's a different kind of audit than what the IRS does. So we'll talk about that as we get towards the end of our session. Now, you're probably taking a deep breath by this time going, God, I cannot believe I'm going to get through all this in the next 3.5 hours. Well, you don't have to. Look at the note up towards the upper right corner. Here's what I'm going to do. I'm going to get on and go for about 50 minutes, 50 minutes, and then I'm going to break for 10 minutes. During that break, you're welcome to do whatever you want to. You can go beat your head against the wall. You can go trotting around. You can go get a drink, maybe a stiff drink. You can do whatever you want to for 10 minutes. Check your email, update your Facebook profile, whatever you want to do. Then come back. We'll do it for another 50 minutes, and we'll take another 10-minute break. And we'll do that all the way until we're through this webinar. My experience has been in doing a lot of webinars during the pandemic era that this is a good pace. It gives us enough time to get in some material during those 50 minutes, but then you get a little bit of time to take a break and clear your head before we go back under again. All right, so let's jump into some of these basic concepts. Now, I don't know about you, but on May 15th, of course, usually April 15th, but this year, May 15th, I felt somewhat better knowing that Einstein said the most complicated thing to understand is the income tax. Somewhat better as I was trying to complete my personal return. And I'm thinking, God, the poor guy didn't even have TurboTax. Poor Einstein. Man, if he'd had TurboTax, maybe he'd been better off. But, you know, if he thinks it's complicated, what the heck are you and I going to do? Well, a much lesser individual named Greenwood said, you know, one of the hardest parts of the SBIR STTR cost proposal is this cost estimate. People underestimate this. They underestimate its importance, as we've already discussed, but they also underestimate how hard it is because they think, well, you know, I understand the agency will give me 150,000, so I think I just put that number in the lower right corner, and then I just put out a bunch of other numbers that hopefully add up to 150,000, and I'm good, right? No, you probably have made gross mistakes up one side and down the other and have left out critically important things like fee or profit. So it is one of the hardest parts of the proposal, but I find time and time again, it's underestimated in its importance and its difficulty. And people try to throw it together in the last 15 minutes before submitting the proposal and end up losing money. So the complexity of this government accounting thing, now, of course, you know, somebody like KPMG, Marwick has no vested interest in scaring you, right? But what they had to say was government oversight, scrutiny of contractors' policies, practices, controls never been more intense, comply with the myriad of statutory, regulatory, contractual requirements. Company officials must often act simultaneously as accountant, financial expert, auditor, training specialist, operation analyst, program manager, engineer, and lawyer. You go, what's the big deal? That's just a standard day at the office for a small business, isn't it? You got to do all that stuff, don't you? Yeah. Well, the point that KPMG is trying to make here, and it's an important point, is you are entering a system that wasn't designed for you. The federal procurement system was not designed for you. It was designed for the federal government to buy huge things from huge companies. So this system was designed for the government to buy an aircraft carrier from a big shipbuilding company. This system was designed for the federal government to buy fighter jets from a big aerospace company. They take that system which, think about that, you got literally thousands of people inside the federal government involved, and you got thousands of people within the big business involved, and they all work together to hopefully come to a fair price that the government pays for that aircraft carrier or that fighter jet. They take that system that ordinarily would be run by thousands of knowledgeable people, and they fit it over the top of you as a little small company and over the top of the little SBIR program. It is a lousy fit. Okay, I just want you to realize that. It's going to be like a cheap suit. It is a lousy fit. But that's what you have to deal with. You know, they have taken this system and knocked the corners off a little bit, made it a little bit softer in some respects, but overall, it is a system that is not designed for you. You know, that's depressing. Got any good news, Greenwood? Well, first of all, cost isn't part of the selection criteria. I have never, in my, 30 some years being in SBIR, I have never seen comments from a reviewer that said, you know what, we picked the cheaper proposal. I have never, ever seen that. Never. So it's not part of the selection criteria. Now, a couple of notable exceptions. One is when it looks like you are proposing the stars and the moon and everything in between, and you're only asking for $150,000. Then the reviewer and the federal agency says, wow, these people apparently don't know what they're doing. I had one this morning. Boy, these people are not only going to accomplish everything you could imagine, but then they're going to commercialize it all in phase one. And it's like, come on, give me a break. There's no way you can do that. That's the reviewer's response. You can't do all that. And your credibility is diminished because they realize they give you the money, you're going to burn through it trying to get the work done. You're not going to get the work done. You're going to run out of money. You're not going to accomplish anything. Everybody loses. So they will try to, quote unquote, save you from yourself and not give you an award when you grossly understate the budget. There's another time when cost is part of the selection criteria. I was contacted this past year by a company that said, you know, we submitted to the military our SBIR proposal. It wasn't funded. When we asked for a debrief for feedback, we really didn't get any. So Greenwood, would you look at our proposal and tell us what you think? And I actually do this quite a bit. I review proposals once they've been submitted and people are wondering, you know, why were they not awarded? Now, I don't have a crystal ball to tell you why a reviewer didn't fund your proposal, but I can point to weaknesses. So I'm reviewing this proposal for this old company, and it's an okay proposal. It's not perfect by any stretch of the imagination, but it's not bad. And I'm kind of getting to the end. I'm going, you know, I really haven't found anything that just really sticks out as why this proposal would not be funded. And then guess what? The last few pages would be the budget. And I'm looking at the budget and I'm looking at the lower right-hand corner, and the amount for this proposal is $150,000.47. Yes, 150,000.47. Okay. Now the instructions clearly state budget cannot exceed $150,000, period. And there's no, you know, plus a few pennies or rounding error or whatever. It's 150,000, period. So I'm looking at this going, you know, I'm just wondering if the rules police, and these are the people in the agencies that tend to scan over these proposals when they first come in to see if any of them are going to be thrown out on nitpicks for not following the rules. I'm just wondering if the rules police saw $150,000.47 and said, well, that clearly exceeds $150,000, and they threw that proposal out on that basis. You know, we'll never know. And frankly, the agency would never admit it, but that's another exception where cost can become a very important selection criterion because you exceeded the maximum amount. Second, and this is kind of, it's almost laughable, guys. The government kind of goes, oh, you're a phase one applicant? Oh, then you're a complete moron. You don't know what you're doing. I'll have to treat you like a moron. And so I find contracting officers, grants administrators who will sit there and hold your hand and explain to you every little thing and let you change your answers because if you're proposing a phase one, they think you're a moron. Now, interestingly, it doesn't seem to matter if this is your first time you've ever written a phase one proposal, or whether you've had 75 phase ones and quite expert in this area, you still get treated like a moron on a phase one. Guess what happens when you get to phase two? Well, you are now government accounting cost proposal expert, and they'll now rake you over the coals, even try to trick you. So it's kind of an odd phenomenon, but at least the good news is if you're submitting a phase one and you're even negotiating a phase one, they will tend to be somewhat careful and sensitive and not be too harsh with you. I've actually had, as I said a moment ago, I've actually had contracting officers explain why they think a company made a mistake in their cost proposal and then allow them to change it in negotiations. So, you know, again, it's pretty nice being a moron. Sometimes it's good being a moron, right? Or at least they think you're a moron, they let you change things. Third thing that's good news, the contracting officer, you know, you and I are sitting here going, it's us versus the government, right? We, small company, versus the agency. Well, not actually. It's actually us, the small business, versus the technical people who want your project and the accounting people who are doing all the bean counting and worrying about all the regs and rules. The contracting officer, this bean counter, actually has some pressure on them because the technical people in your agency have, by this point, if you've been selected for award, they have spent an awful lot of time and effort picking you from amongst all the other candidates. And that means that they have feeling some pressure to negotiate with you and come to a contract that is going to be satisfactory to all involved. And this quote kind of, you know, this is a contracting officer kind of gets that. We don't want to lose your negotiations. We'll work together to come to an agreement. Don't take this to mean you can kind of do whatever the heck you want to and everything will be okay. It just means that you got a little bit of leverage there because the agency has invested a lot by the time they have said we want to make an award deal. And finally, believe it or not, Congress actually sometimes does something helpful. And in this respect, they do something like lessen some of the accounting rules. Now, a more common thing they like to do is increase the threshold dollar amount of a contractor grant beyond which certain regulations kick in and below which they don't apply. So years ago, there were a whole bunch of rules that applied to any kind of federal procurement that exceeded $25,000. Congress actually increased that by legislative action to contracts and grants exceeding $100,000. Now that used to help with SBIRs and STTRs when the cap on those projects, phase ones, were about 100,000. Of course, now that doesn't help you when we're doing 150, 200, $250,000. All right, are you ready for the fundamental concept that you must understand? Now, I don't know if you read the fine print when you registered for this webinar. The fine print said, warning, this webinar will change your life. Yeah, it was there. Again, it was fine print. You have to look very carefully. But the fine print says, warning, this webinar is going to change your life. This is the part of the webinar that is going to change your life. I sure hope you're ready for this, because when we go through this and you finish today's webinar, you will never see the world the same way again. So you ready for that? You okay with that? Okay. If not, you know, there's still time to log off or you know, go do something else for about the next 20 minutes while we cover this concept. But for those of you who want your lives changed, here we go. I want you to understand the difference between a direct cost and an indirect cost. Now you're going, you know, this is life changing. I thought this was like, you know, some insight into the meaning of life or something, or how to turn water into gold. Greenwood's talking about direct costs versus indirect costs. How is that life changing? Well, it takes a little while, guys. This isn't like a lightning bolt that hits you. It has to kind of soak in, okay? So trust me, this is gonna change your life. Direct costs versus indirect costs. So what's a direct cost? Well, a direct cost is a cost that you incur and that because you got a particular project, particular client that you're doing work for, and you bill that cost to that client, okay? So in the old days, when I would do workshops live, then I would have travel costs. Well, that's a direct cost because I would not have traveled to, in our case today, Little Rock to do a workshop if it were not for the fact that Rebecca asked me to come in and do a workshop. So that would be a direct cost. Now, even in the webinar environment today, I'm sitting here teaching a webinar. Guess what? I'm getting a salary. And the salary that I earn while I'm doing this is a direct cost, because I wouldn't be doing this if I didn't have this contract to perform this webinar for Rebecca and the Arkansas SBTDC. Okay, so those are direct costs that are directly tied to a project and can be billed to that project. All right, so that's direct costs. What's indirect costs? Well, if it ain't direct, guys, it's indirect. It's everything else. Now, if you don't find that to be terribly helpful definition, try this one. I like to think of indirect costs as the cost of being in business. What are the general costs of being in business? Now I'm sitting here looking around my desk. I got this smartphone over here. I got to pay that bill every month, Verizon. Indirect costs? You bet, right? I got a smartphone because I'm in business. I don't have a smartphone because I've got a webinar contract with Rebecca. I have a smartphone because I'm in business. I got to have a smartphone. Got to do that. I'm teaching this webinar off of this here Microsoft laptop. Cost of that laptop, that's an indirect cost, right? It's not tied to any particular project. It's a cost that I have to incur because I generally need a laptop to do my line of work. So that's the difference. Direct cost is something that is tied specifically to you performing work for a client. Could be SBIR, doesn't have to be. Could be government, but it doesn't have to be. Just doing work for a client. Any cost incurred doing that work is a direct cost. Anything else that you have to pay being in business is an indirect cost. Now, I want to broaden the indirect cost definition a little bit. Notice the first part of what I've actually written here, a cost tied to 2 or more projects. Okay, so indirect would be something where I have 2 or more projects that cost was incurred. So let's say, again, I fly to Little Rock to teach a workshop for Rebecca, but while I'm there, I also go over and visit some folks at the PTAC Center and do some consulting with them. Well, now that travel cost, which I was saying was a direct cost to this workshop, is no longer tied to this workshop because it's now tied to the workshop and it's also tied to the consulting for the PTAC. So costs that get incurred when you're doing multiple projects, those also tend to get lumped into indirect. Little muddier than the other concept of general cost of being in business, but I want you to realize there's that additional part to this. All right, so everybody okay with this? Everybody okay with direct versus indirect? You're going, I still don't see the life-changing thing. Guys, it takes time. It soaks in, okay? All right, I'm glad everybody's comfortable with it. Let me see if I can make you a little bit uncomfortable with it. Let's say we've got an office at the Small Business Incubator, okay? Rent we pay every month on that office for our business. Would that be a direct cost or an indirect cost? Okay, I think most people would say indirect. And the reason why, because you got to have an office when you're in business. You got to have somewhere to conduct business. You got to have somewhere to have your files. You got to have somewhere to write your reports. So the rent on that office is indirect, okay? Now, we get notification this afternoon that we have been awarded a Department of Defense contract, SBIR contract. We get done celebrating, we go, wait a minute, you know what? There is no way that we can do the DoD project in this little office of ours. You know, we need a little electronic laboratory space to do some of this work, and we need a heck of a lot more square footage than we got right now. So we go down, we talk to the manager of the incubator, and thank goodness they have got kind of electronics lab area that's available, we rent it. Okay, now, is rent an indirect cost or a direct cost? Now, let's break it into its component parts, because we're now running two different things. We're running an office, we're running a lab. Now, the office, has the nature of the office changed at all? No, we still need an office because we're in business. And whether we have this DoD project or not, we got to have an office. So we still have the rent on the office, and that's an indirect cost. So that gets plugged in like we just said. But what about this lab we just rented? Why did we rent the lab? Because of the DoD project. And we would not have rented the lab without the DoD project? That's right. Well, that kind of looks like direct costs, doesn't it? Well, congratulations. Notice how you're understanding the concepts, and you're also seeing that this is more complicated, isn't it? Now you got, notice your accounting system now needs to have not just a category that says rent expense. Now you need a rent expense indirect, and you need a rent expense direct. Okay, one day we're working in our little office, and we turn around in our chair to pull something off the printer, and we whack our elbow into that file cabinet. Oh man, right on the funny bone. Oh man, that hurts. This is ridiculous. We have this stupid file cabinet down here. It's always in the way. I'm always hitting it. Why don't we move it down to the laboratory space? You know, when we rented that lab for the DoD SBIR project, it's actually a little bigger than what we needed. So there's some spare room down there. Let's just haul this file cabinet down the hallway and stick it in the lab space. So we do that. We're so proud of ourselves. Well, what did you just do in terms of the nature of the rent expense? Now, again, the office is still indirect, right? Because we got to have an office be in business. That's indirect. But what did you do to the nature of the rent on the laboratory space? You argued, I heard you, I have witnesses, you argued a few minutes ago that you needed that lab space exclusively for the DoD project. And now that is no longer true, is it? Because you are now telling me that you need that space, not just for the DoD project, but you need it for your file cabinet. You need it for some indirect stuff. Notice now the nature of that rent is getting kind of muddied, isn't it? You go, aha, I've got a solution to this. You know what I'm going to do? Because being a good male, I always carry a roll of duct tape with me, right? So I'm going to get my roll of duct tape down. I'm going to put a pattern on the floor down in the lab space around the file cabinet, you know, enough that I could be standing in front of it with the drawer pulled out. I'm then going to make a path from the file cabinet to the door. I'm then going to measure the square footage inside of the path and the area around the duct tape. Now generally you want to use the center point of the duct tape. Okay, so calculate the square footage inside the path and inside where the file cabinet is kept. Calculate that as a percentage of the total square footage of the laboratory space. Take that fraction of the laboratory rent space, put that into indirect, keep the rest of the rent on the lab space as direct. Once again, see how this is getting a little more complicated. Now you're also sitting there explaining this to your bookkeeper, and your bookkeeper is looking at you like you flipped out, and also in their back of their mind, they're going, I'm going to need a big raise if I'm going to put up with this kind of silliness.
Jim,
then one day,
questions when you have.
Okay.
So the first question asks, we are a medical device company in the R&D stage, and almost all of our costs are focused on internal R&D. By definition, we have one project, the R&D on our product. Would the work we do under our SBIR be by definition a second project?
Okay, I'm understanding the SBIR is the second project, but the first project is IR&D, Independent Research and Development.
Right.
Yeah, that would not be treated as a project, because you're not doing that for a client. You're doing that, and I don't want to. This sounds flippant, but I'm trying to use the terminology that the government uses. You're doing independent research and development because apparently you can't find a client to pay for it. So that's just your internal costs. So no, it would not be a second project.
Okay, great. The next one is, can you explain what's meant by the negotiation process? What is being negotiated?
Okay. Generally, you get notification, and I will sound like a broken record today, but it varies by agency. But in general, you've submitted your proposal, your SBIR STTR proposal, phase 1. You will get notification that they want to make an award based on the technical merits of the proposal. Negotiation will be typically a phone call with a contracting officer, grants administrator, somebody who's not a technical person but is a administrator within the agency, and they'll ask a few questions about the project, and generally will ask questions about the budget, trying to make sure that the budget is there's some basis for the budget, that it wasn't just made up, and they'll ask several questions about the budget. It's also your opportunity, quite frankly, to maybe negotiate a better budget than the one that you submitted. If you're like a client I've got right now, where she submitted her budget to the agency several months ago, she just got notification of award, and now she's come to me to ask me about the budget. The budget has problems, and I'm trying to advise her on some things that she should try to negotiate with this bean counter administrator to give her a better budget, and also to be more realistic to what the government wants. So it's not an intense, sit down across the table, you're 3 people and your lawyer, and they're 4 lawyers and they're 12 people. It's not a big deal like that on a phase 1, but it is still important, because it's a lot of times setting out the parameters of what you're going to get paid, when you get paid, what the terms are going to be on expectations of what's going to be delivered and things like that. All right. So we were remember, we had just done our duct tape thing, right? With our space around the file cabinet and our path to the door. We're very proud of ourselves, because we really understand this direct versus indirect thing. Then one day, an auditor shows up from the federal government, and we're showing her around and explaining to her the project, the SBIR project we're doing for DoD. And she says, "Yeah, but what I don't understand is what's the duct tape thing?" And you probably explained, twirled around in my desk chair, whacked my elbow, it hurt, moved file cabinet, tainted space, no longer totally direct, put down duct tape, I calculated square footage, made that indirect, kept the rest direct. And she's slowly nodding, and you just know that she is just so impressed with your understanding of direct versus indirect and how you've used duct tape and all that good stuff. And you get done explaining it, and she says, "No, rent is always an indirect cost." To which you respond, "Yes, ma'am." Now, you see how this little simple direct versus indirect thing can get a whole lot more complicated in practice? Yeah, welcome to the world of government accounting. And you would be amazed, maybe not, but most likely you'd be amazed how many times in budget discussions between the small business and the federal government, it has something to do with direct versus indirect. They think you ought to put something into indirect, you think it ought to be indirect. They think you're putting too much into indirect, want to know why. You think you're putting more into indirect because they've told you to put stuff there that, that is questionable whether it's direct versus indirect. A lot of discussion goes on about this. So be prepared for that. And I also want to forewarn those of you who might be scientists and engineers, and I bet there's a few of you out there, you're used to precision, you're used to data, you're used to statistical significance, you're used to things that are right, things that are wrong, things that are true, things that are false. Well, welcome to the world of government accounting, where that ain't the fact. That ain't the way it's done. A lot of it comes down to, it depends. And part of what it depends on is how well can you negotiate and argue for your position. And how well does the auditor that you're working with or the negotiator you're working with understand their own system? And how many things have you given in on already, so they already feel like they beat you up pretty good, so they're not going to beat you up on this? Versus, have you held tough on everything that they've tried to ding you on in the negotiation, and now it's the last thing and they're going to get something because they want to justify their existence? it's like buying a used car, guys. You're not quite sure when you go into the car lot what's going to happen, right? You're pretty sure you're going to get screwed, but you're just not sure exactly how it's going to happen, right? Well, maybe that's not a total analogy here, but you know that the government's going to try to whittle you down on something. You're just not quite sure what they're going to try to do or how they're going to do it or what argument they're going to use to do it. So the wishy-washy and the depends and the negotiations is something that can be very frustrating for someone that's a very, very quantitative, very black and white sort of individual. All right, we spent a lot of time on this slide, so let's keep moving. But again, guys, direct versus indirect, this is going to change your life. Yeah, it's going to change your life. So let's show the relationship of direct versus indirect and some of these other terms that perhaps you have seen. Start over on the left side, and I've got all allowable costs. Don't worry about allowable right now. Let's just talk about costs, all costs. Now, this is from the government standpoint. What are all the costs that you're going to ask me, the government, to reimburse you for on this SBIR? That can be divided into three categories. Those are the direct costs, the indirect costs, and then the fee or profit. Now, direct costs, you know, we've already talked about this. It's the cost of doing the work for a client. And when it comes to SBIR, STTR, the typical SBIR, STTR project, most of it's going to be labor because R&D tends to be labor intensive. So a lot of your direct costs will typically be the labor of your employees. Okay. But you may have materials required in the research. You may have a subcontract or consultants. Those are included as direct costs if they're helping perform the work. Project-related travel would be direct costs. Okay. All right, that's all direct costs. Now come down to indirect costs. Now look at how indirect costs branches out and then branches again, branches again. It's more complicated than direct, isn't it? Just by how much it takes up of this poor little diagram, you can see how much more complicated indirect is. Well, let's break it into its component parts. So you got indirect costs. These are your general costs being in business. You can divide those or subdivide those into overhead versus G&A. Overhead can be further subdivided into fringe versus, lacking a better term, I just call it other. Fringe overhead, what's fringe? Well, these are the things, maybe you remember before you started your business and you had a real job. Remember when you got time off? Remember when you got health insurance benefits? Yeah, that's what we're talking about, fringe benefits. Now, it also includes some things that you might have because the IRS tells you have to have it, and that would be employer payroll tax. In other words, when your employee gets a paycheck, you subtract out Social Security, Medicare out of their paycheck, but guess what? You also have to match it out of the corporate coffers, not out of their paycheck, but out of the corporate coffers. You have to match what you took out of the paycheck for Social Security and Medicare. You also have to pay, as a company, federal unemployment tax. You can't take it out of the employee's paycheck. You have to pay it out of corporate coffers. And you probably have a state income tax, or excuse me, a state unemployment tax in addition to that. State unemployment tax, again, like federal unemployment tax, can't come out of the employee paycheck. You have to cough it up. So that's what I mean here by employer payroll tax. It's the payroll taxes that you have to pay that come out of your pocket or out of the company's pocket, not out of the employee's paycheck. All right, so those are the fringe benefits. Some of the things we were just talking about, rent, phone, utilities, support labor, office supplies, again, just general cost being in business. All right, so that's all overhead. What's this G&A thing? All right, well, first of all, there's disagreement over what G&A stands for. And it's not just disagreement among you and me, it's disagreement within the federal government. They themselves can't decide what it means. Some of them will tell you it stands for general and accounting. Some will tell you it stands for general and administrative. Doesn't really matter, it's called G&A. All right, so what's G&A? Well, G&A is a big company concept, and it's the way most people will explain it. Suppose we're up in the Seattle area and we're walking around the Boeing plant up there, the big factory up there. And here on the left side, there's a hangar and they're building a 787 Dreamliner, hoping it won't catch fire. And here on the right side, there's a hangar and there's a fighter jet they're building, okay? And then right in front of us, there's a building, office building full of people that day to day really don't do anything very useful. I mean, useful in terms of putting a plane together. You know the people I'm talking about. It's the president, it's the vice president, it's the chairman of the board, it's the CFO, it's the CTO, it's the SOB, it's the shareholder relations, strategic planners. It's all the people that day to day don't put together airplanes at Boeing. Day to day, they steer the giant Boeing corporation through the seas of commerce. That's their job. That, my friends, is G&A, the general cost being in business. So ask me, on a typical day in your small business, how much time do you have to steer your corporation through the seas of commerce? Not a whole heck of a lot, right? Yeah, so most small businesses tend to have very little allowance for G&A. Now, I'm going to encourage you to have some, and it's probably more than you have been thinking you deserve, because look at some of the categories that go under G&A. General accounting. Now, we're pretty early into our little webinar here, but don't you already get the feeling your accounting system's going to have to be a lot smarter than it probably is right now? And you're going to have to spend a lot more time on it? And you might even have to upgrade to fancier software? Yeah. Good thing that's under G&A, and you can charge some of that to your clients as part of G&A, because that's accounting. Then we just have the question about IR&D, independent research and development. This is research that you are doing on your own. Nobody's paying for it. You're doing it out of your own pocket. That's part of G&A. And then bid and other proposal. Wow, bid and other proposal, bid and other, that sounds almost like I can get money through G&A to write future proposals. Bingo, that's exactly what it is. Yeah, is this not cool? You can charge as part of your G&A to your current clients. You can charge them some money and use that money to pay your people to write proposals to get more projects on which you collect G&A and which you get money to write proposals to get more projects. This is kind of the way you build the company, right? You charge some G&A that helps cover the cost of future bid and proposal, and you keep charging that. So highly recommend that you include some G&A in your indirect costs when you start figuring out what your costs being in business are. Then there's this third category, fee or profit. Now you're going, well, that's not a cost, that's a benefit. Well, remember, I'm looking at these terms from the federal government standpoint, the customer standpoint, and you are billing them for direct costs plus indirect costs plus hopefully some fee or profit on top of that. So it is a cost to them. Now, it's a really important benefit to you, and we'll talk more about that a little bit later in the webinar here. Now, I want you to be cautioned that my little diagram here is just my view of the world, okay? You will find other people who have different views of this world or different terminology for what you're seeing here. So some of you involved with National Institutes of Health, you probably have heard the term Fna. Fna. Wow, first time I heard Fna, I was looking at my little diagram here and I'm going, gosh, I don't see Fna on this thing. The only thing I can figure is Fna was before G&A, and if I live long enough, I might see the day when we have H&A. Right? There had to be some logic. Well, you don't look for logic in government accounting and cost proposals. So what is Fna? That is a term used by some agencies, predominantly NIH, instead of indirect costs. So instead of calling it indirect costs, they'll call it Fna. So G&A is actually a subcategory of Fna, but only at NIH. Now, isn't that scary that you understand what I just said? Yeah, you're getting the hang of this, aren't you? You're getting the terminology down here. Yeah, and IR&D or IRAD is part of G&A, which is part of Fna at NIH. Oh, but actually NIH doesn't allow IRAD as part of G&A, which is part of Fna. Now, again, you understand what I'm saying because you now are starting to understand the alphabet soup that we're dealing with here. The other thing that you'll see is a simplified version of this chart where indirect costs are not separated into overhead versus G&A, and overhead certainly isn't separated into fringe versus other. I'm just trying to break it down to simplify what each piece is. It's the old, how do you eat an elephant one bite at a time? Well, how do you understand government cost proposals one cost category at a time, right, or subcategory at a time? But what I'm going to show you in our little exercise here in a little bit, the indirect costs would all be lumped together, so you wouldn't segregate overhead versus G&A, you wouldn't segregate fringe versus other, it'd all be lumped together as indirect. Other thing I want you to be aware of is you will hear times when people use the term G&A, and what they actually mean is indirect. I see this at the military where they will use the term G&A and they really mean everything that you see under indirect. So one of the things you got to worry about when you're using these terms, make sure you and whoever you're talking to define your terms. Make sure you and they are talking about the same thing, because if I'm talking about G&A as I mean it in this little chart, and you're saying G&A meaning all of indirect costs, you and I could have a conversation that is pretty much meaningless because we're talking about two entirely different things. All right.
Jim, I have a couple questions that came
Basic
in
requirements. Okay.
for the previous slide.
Go for it.
So
Okay.
one question asks, if I messed up the employer payroll tax and maxed out the 256K, how will it affect the possibility of award, and how would the contracting officer handle the mistake?
There's a couple of choices in here. One could be, and part of this depends on, are we phase one versus phase two? This is easier done in phase one, and it's easier done if you proposed it, but you've not yet negotiated it. But I think what your argument becomes is, gosh, I put in the best proposal, cost proposal that I could with my understanding at the time. I have taken the initiative to learn more about government cost proposals and accounting, and I've come to realize that I should have included some indirect costs, most notably the employer portion of payroll taxes, which of course if I don't pay will cause some grief with the IRS. I respectfully request that I be allowed to revise my cost proposal to include at least that portion of indirect costs. And you kind of keep your fingers crossed and hope they say okay. If they don't say okay, then another question would be, did you request fee? As we show in our chart here, did you request fee? If you did, then you're going to probably end up paying that out of your fee. If you didn't request fee, which is another mistake, but see it all the time, and you didn't put in any indirect cost to cover your payroll taxes, then you're going to have to cough up that money out of your pocket. You'll have to find a way to pay for that, probably out of, we'll call it general corporate resources, because that sounds better than out of your pocket.
Okay, great, thank you. On the next question on this, I'm doing both engineering and CEO, but didn't do anything in the bucket for her G&A. Will this be a problem?
Okay, so sounds like they're saying they put some of their labor into direct, they put some of their labor maybe into overhead, and they're wondering about should they put some of their labor into G&A. There's a lot of moving parts here, so I'm a little hesitant to give you a grand answer. If in your cost proposal you lump together all your indirect costs, then you're okay, because overhead and G&A come together if you lump them together under indirect. If you didn't do that, but this is a phase one, and it's what's called a fixed price phase one. We're going to talk about fixed price versus cost plus type contracts and grants here in a little bit. But if it's fixed price and the government has negotiated and agrees that your fixed price is fair, or that you guys have agreed on a fixed price, then again, I don't think it's not gonna make a lot of difference. But if you were in a phase two and it's a cost type contractor grant and you've detailed out overhead versus G&A, then what you should do is go back and tell them you want to renegotiate your rates because you have learned that you didn't do your rates quite right. An issue with doing that is the government really doesn't want to see you because you're coming in with this little piddly, say, $1 million phase 2, and they're sitting there on their desks with a pile of contracts for tens of millions of dollars that they're trying to negotiate, and they really don't want to take a lot of time away from those really big negotiations to work with you on this little issue. So, you know, and again, we could talk more about it. If it is a phase 2 situation, it is more complicated. We could talk more about that. Now, Rebecca, this is a good time to do our little ad about the one-on-ones. You want to tell them what the opportunity is there?
Sure. So next Thursday, June 3rd, also the same time frame, 8:30 to noon Central. We're going to have one-on-ones with Jim. So it can be that he reviews your draft cost proposal, your indirect cost estimate, or other types of draft sections related to accounting for SBIR, STTR. And you can meet with him. We'll have 25-minute sessions. And so that'll be a good time frame to cover a lot of your key questions specific to your projects and accounting. So if you are Arkansas-based, you'll have first dibs at this opportunity. Please email me at rctodd@ualr.edu, and we'll get you signed up on the schedule.
All right. And you've got your, I think in the chat function, did you put that in there? You got your email address and all in there?
At the very top of the chat, you'll see this in a message there. So you'll have my email there as well.
Okay. So that's a great opportunity if you're an Arkansas company to schedule some time. We'll talk next week, and hopefully in that kind of time frame, you can explain to me more of the situation, and I can, based on that, give you hopefully better guidance on that. All right, great, thanks. Any other questions, Rebecca?
You have some more. Is it about time for the break, or do you want to after the break?
Well, it's let's take we'll take another question, then we'll take our break.
Okay. So this next one asks, what does Fna at the NIH stand for, and what costs are ascribed to Fna?
Okay, so it's facilities and administrative, and this is actually down in this quote at the bottom of this slide. Facilities and administrative, and it is the same thing in my little chart here as indirect. So you just scratch out indirect and pencil in Fna. Unfortunately, NIH is not consistent about that. So literally within the NIH FOA, they will say, well, we at NIH do not use the term indirect. We use the term Fna for facilities and administrative. I swear, guys, the next sentence starts, indirect costs are defined as. And it's like, wait a minute, guys, you just said you don't use the term indirect, and now you're defining it. It's that screwed up, guys. It really is. And at NIH, you will see Fna used interchangeably with indirect. Now, the quote I gave you here at the bottom of the page, it's even worse. They use the term Fna, indirect, and overhead all interchangeably. And you guys are wondering why this accounting stuff is confusing? I mean, it is bizarre how badly the government itself misuses its own terminology and makes mistakes, which says something about the system being too darn complicated. But I just want you to, and I'm not trying to beat up the government, I'm just trying to say, I want you to be aware of that sometimes you got something you don't understand, it's a head scratcher. It may not be you, it may be that the government person you're talking with doesn't know what they're doing, or you see something written like this quote at the bottom of the page where it's just gibberish. Just gibberish. That sounds like a good time to take our 10-minute break. So I have got Central Time, I've got 9:29. So let's come back at 9:39, and we will continue with our discussion at that time.
That's good. Thanks, Jim.
Okay, it looks like we're ready to get started again. Rebecca, do we have more questions we wanted to start with?
Yes, we do. Just a second here.
All right.
So the first question is, does this process allow for 1099 contractors?
It does, but basically, and this is a bit of a gray area, like we haven't talked about any of those yet, right? When we talk about employees, generally they're only going to include W-2s, although leased employees are also included in that category of employee. Others get shuffled into subcontractors, consultants. Now that can still be, when we're talking direct versus indirect, they can still fall into direct. So if you have somebody that's a 1099 and it doesn't look like they fall into a situation where we can treat them as an employee, then we would treat them as a subcontractor, and it's still a direct cost, which is fine. The issue typically that comes up when questioning whether they're an employee or not is whether they qualify as part of the 33% that the maximum 33% that you can subcontract on a phase one versus are they part of the 67% that's not being subcontracted? So that's usually the issue that comes up.
Okay, great, thanks.
Okay.
This question asks, I think we already covered that actually.
Okay.
Does the process allow for outside funding as well? If phase one costs more than the grant allowance, for example, we would include that outside funding in the budget.
What you would do is, now let's see if I can explain this. What we're showing in this chart would not be project by project. This would be your company for typically a annual period, either a calendar year or a fiscal year. Time of year we're in right now, you would probably be doing this for a late, maybe a federal fiscal year time frame, like October 1, 2021 through September 2022 time period. So this chart would be everything that's going on in that 12-month period. And from that, you end up estimating indirect rates, and then you would apply that indirect rate to your cost proposal with the agency. If you're doing some outside funding, there's kind of two ways you can handle that. Is one, you can try to build it into the overall budget and say, okay, the whole budget is $300,000, of which we're requesting $250 from the SBIR program, and we'll put in $50,000, and you put it in you put the whole $300K into the into the cost proposal form. Two concerns with doing that. One is, again, you got to worry about the rules police. Are they going to just see that and say, oh, you exceeded the $250K maximum and throw the thing out without understanding that some of this is a cost match? The other problem with doing that is you run the risk of the government then saying, oh, well, all these crazy rules that we've got now apply not just to the $250, that's our money, we're also going to apply them to the $50,000 of private money that you put into it. So a lot of times what I would prefer you do is you define if you will, a smaller SBIR project and build in the indirect costs, the fear profit into the budget of that particular project. And then in the technical proposal, explain that this project is being supplemented by an independent project being funded privately, and explain what that work is going to do. And that way, there's no confusion over the budget. There's no confusion over whether or no threat that the federal government is going to regulate how you use the private money. It's kept entirely separate.
Okay, so it sounds like the simplest option to keep it in the narrative versus in the budget. Okay.
Yeah, I think so.
We have one more. Well,
okay.
One more, yeah. How does a single person business handle G&A along with R&D costs? Can we exceed 40 hours a week? For example, if I'm the business owner and PI, I probably will work more than 40 hours a week.
Mhm. Two issues, at least two issues here. One is in the structure that we're seeing here, what you would want to do is build all these costs on the basis of what you think your typical work week is going to be. So if you say, you know, the way I see this, we're going to be working 50-hour weeks, then you build all these costs on the basis of 50 hours, not 40 hours. Because if you build them on the basis of 40 hours, and then you're actually working a 50-hour work week, you're going to overbill the government for indirect costs. And obviously they're not going to be happy about that. So you'd build it to whatever you think is going to be the typical week number of hours. That takes care of this. Well, then you still got to worry about labor law. And typically this is at the state level. Your state will say, what is allowed or disallowed in terms of overtime. Are you and let me see if I remember the terminology, exempt versus non-exempt employee? It's not as simple as salary versus hourly, but if you are an exempt employee, then you can be working extra hours and not be required to put in or not be required to be compensated for the overtime. And I said state, but actually the feds are in that too. And it goes all the way back to Obama was making some changes to these rules about exempt versus non-exempt. And some of those things, I quite frankly don't know where they ended up. They were not being implemented during Obama's era. Then Trump comes in, and you can imagine Trump sidelined a lot of that. But I don't know if any of it ever went through. And if it didn't go through, is now Biden going to pick it up and push it the rest of the way through? So it's kind of a gray area in terms of this exempt versus non-exempt. But if you are, as I heard you describe, a one-person company, it's just you, you're going to be exempt because you are the boss, the supervisor, the everything. And I think you can work 50-hour weeks for yourself and not have an issue with that. You just have to base this whole cost structure on 50 hours. Now, when we do the exercise a little bit later, and I'm showing you how to derive this indirect rate, you'll see where I'm plugging in 40-hour work weeks. You would put in my example, 50 hours instead of 40 hours in those places. All right, well, let's press on, and again, have questions. Glad to have the questions. Appreciate those, but I want to keep moving along here. So we got lots of material to cover. Basic requirements. Does your proposal meet the requirements of the agency, the FAR accounting standards? An example of this that has risen in the last couple of years is more and more of the agencies are saying when you put in a labor rate into your cost proposal for somebody, to prove that that's quote unquote reasonable, use a labor rate from the Bureau of Labor Statistics, BLS.gov website. BLS.gov has a whole bunch of different occupational categories. You find one that sort of fits this employee description, and you use that rate. So that's an example of adequacy. If you just say, we're giving 50 grand a year to this employee because we think they deserve it, that's not going to be adequate in terms of justification for that. Data, are they accurate, complete, current, well estimated? And our costs reasonable, allocable, allowable, and consistent. These are the four categories that people don't always recognize. And I want to point to these because particularly reasonable is a big deal when it comes to government accounting. What is the definition of reasonableness? Does the cost exceed what would be paid by a prudent person in the conduct of competitive business? Now, this used to be the prudent man rule. Now we're gender neutral, so it's the prudent person rule. But this is the measure of whether you're being reasonable or not. Are you charging something that more than a prudent person in the conduct of competitive business would charge? Now, does that sound like a very exacting standard? No, not at all. But you are going to be flabbergasted how many times you're going to see the term reasonable or reasonableness in our discussion today and in government accounting, and this is the definition. So a lot of this stuff deciding whether you deserve $75 an hour, $80 an hour is going to be based on somebody's determination of whether that's reasonable or not. Allocable, can all direct costs be assigned to specific projects, and can all indirect costs be reasonably allocated? So if I work 1 hour on preparing the webinar for Rebecca, is my accounting system smart enough that that gets allocated to her project? And then I work for an hour for the University of Wyoming, does that get allocated to that project? Your system needs to be smart enough to do that. And you'd be amazed how many accounting systems are not smart enough to do that. And are all indirect costs reasonably allocated? In other words, if I have a really lucrative contract with, let's say, the University of Texas, I can't dump all my indirect costs on that lucrative contract and not put any on a little skinny contract that I've got with Louisiana State University. I have to allocate indirect costs reasonably. See, there's that reasonable term. And a reasonable way would be, for example, if the Texas contract is 75% of my revenue and LSU is 25%, then I would allocate 75% of my indirects to Texas and 25% to LSU. Allowable, are the costs consistent in terms of what's allowed, allow certain limitations, expressly unallowed? We're going to talk more about that here momentarily. And you got to treat costs the same way. You can't treat a certain cost as direct on one project and then treat it as indirect on the next project. You got to be consistent. You know, maybe it's more convenient to change them in terms of direct versus indirect from one project to the other, but you can't do that. You have to be consistent in what you do. All right, why don't I just fake it? I mean, that's probably what some of you were thinking during that little 10-minute break is, geez, this is way too complicated. I think I'm just going to make up my indirect rate. Well, you know, if you don't come in with a defensible rate, some of them are going to stick you with rates that are not terribly favorable. And the classical example is National Institutes of Health says on a phase 1, if you don't have an approved rate with any federal agency, we're going to cap you at 40%. In phase 2, they say we're going to continue to cap you at 40% unless you have either this approved rate with some agency or you are prepared to negotiate a higher rate with us. Now, I'm going to tell you, in my opinion, by the time you're done with today's webinar, you would be prepared for that negotiation. You could, in my opinion, negotiate defensively a higher indirect rate than the 40%. So don't feel you're stuck at that rate. You know, if you just make up your rate, you know, you could be pretty close. My example here is you're off by a few percent and you're going to lose $10,000 on a little phase 1. And that goes up a lot more in phase 2. You'd say, well, I don't want to lose money. Well, if you overcharge your indirect rate and under an audit or other circumstances, Uncle Sam finds out about that, then you're going to owe money back to the federal government with potential penalties and interest and maybe some legal charges if they think you did it intentionally. So you really just can't kind of fake the whole thing. Two types of contracts that you deal with in grants that you need to be aware of. One is called a fixed price contract or grant. And this is typically what's done in phase 1. So what they will do is let's say you bid $200,000. They want to make an award. They negotiate with you, and you and the federal government agree on $190,000. And they put it into a fixed price, firm fixed price contract. Well, what that means is if you can do all the work for $150,000, well, you've actually made a real handsome profit because you still get paid $190,000. But the flip side is also true, and this happens more often. If it actually costs you, say, $220,000 to do the work, doesn't matter. You agreed that you would accept $190,000, and that's all the federal government's going to pay you. So fixed price says they're going to give you a fixed amount of money, regardless of whether it's too high or too low. You and the government agree to it. So if you are in a fixed price, and this was why I was commenting about fixed price on some of the questions a while ago. When a fixed price is agreed to up front, then there's more latitude, let's say, in terms of how you would use the money if that's agreed upon up front. Now, the other type of contractor grant is a cost type contractor grant, and a very common version of that is a cost plus fixed fee. But cost is the general type of contractor grant here. Cost means you submit a proposal to my agency for $1 million phase 2. You and I agree on $950,000, and we put in a cost plus fixed fee contract. Now, what will happen, again, we agree on a $950,000 contract. If you do the work, all the work, and it only costs you $900,000, I'm only going to pay you that cost, right? I'm only going to pay you the $900,000. Now, this fixed fee add on to that, the cost plus fixed fee, says I'm actually going to pay you a little more than $900,000 because I'll go ahead and pay you the full profit that you would have gotten on the other $50,000. So if we agreed on $950,000 cost plus fixed fee, you do the work for $900,000. I will pay you $900,000 plus, let's say that your fee rate was 7%. I'll pay you that 7% on the additional $50,000 that you didn't need. That's another $3,500. So I will pay you $903,500 on that project. Now, the flip side is if it costs you, again, we agree on a $950,000 phase 2, if it costs you $1,050,000 to do the work, the way this is supposed to work under a cost plus fixed fee is the government, are going to pay you $1,050,000. Now again, because the fixed fee, I'm only going to pay you the profit or the fee on the first $950,000. I actually won't pay you the full $1,050,000, but it'll be pretty darn close. Now, in theory, that's what happens, and you're protected, right? So if you overrun, you're protected on a cost type contract. That's theory. The reality is the government will go out of their way to not pay you more than the $950,000. They will give you every incentive to not force them to pay you more than the $950,000. They will threaten to come audit you to find out why you overran the project. They will point out that your paperwork on the contract says you're supposed to notify them when you reach 90% of your contract balance, and you didn't do that, so you're in violation of your contract. They hate to pay more than what was agreed to, even on a cost plus. So, and worse yet, guys, it's the cost type contracts that causes the government to really want to audit you. So in a lot of ways, cost type contracts, they don't work to your benefit like they should, and they always work to your detriment in that it triggers more audits, and it means you're never going to get paid any more than what you and the government negotiated would be a fair price. So a lot of folks, frankly, would rather continue with firm fixed price type contracts in phase 2. Good luck. You could ask for it in negotiations. I've seen DoD doing more of those firm fixed price in phase 2s. Seems like NASA, if I remember right, NASA does firm fixed price in phase 2s. So some of the agencies already go firm fixed price in phase 2, frankly, to avoid some of the audit requirements and negotiation requirements. And again, this is an individual, and some other quotes that just kind of say fixed prices are maybe something that you're more comfortable with also as a small company because of your ability to control cost, understand and control cost. Now, a little bit of a side note here, and this is something that you're seeing more and more as the agencies diversify their SBIR, STTR programs. Some of them are talking now about OTAs, which are called or are defined as other transactional authority. OTA is kind of a little voodoo thing here, where they say, look, if you'll agree to an OT, other transaction, instead of a contractor grant, we can avoid the federal acquisition regulation requirements. And that sounds pretty enticing because the FAR, as I said, is thousands and thousands of rules. Now, that sounds good, and the idea is excuse me, let's simplify all this. Let's make it easier for you to have a project with the federal government without all the strings of FAR attached to it. But you don't know what strings the government's going to put on you under this OTA, because it basically says, okay, an OTA says the government is going to define a different set of terms that you have to meet. So you have to know what those terms are and whether they're favorable to you or at least acceptable to you. So just keep an eye out for the OTA. It's being used, I'm seeing it more in the DoD, Department of Defense. NIH has the authority to use it, but I'm not seeing it brought up in the SBIR, STTR programs. I'm guessing they're using it more in their academic programs right now. All right, let's talk for a minute about this FAR thing. We keep referring to it and we kind of badmouth it. It's a whole bunch of rules and regulations. I want to cover this pretty quickly because we're a little behind at this point. What is the FAR? The FAR is Federal Acquisition Regulation. Why do we have it? Just as I said before, it's unique, weird stuff. There is no way to rely on the free enterprise system to determine what is a fair price for an aircraft carrier because, you know, there's really not a competitive market for them. So instead, they have the FAR to kind of determine what is a fair price. And over time, more and more, the FAR has also been a way to reflect federal policy. So they can put things in here to encourage you to do certain things. They can put other things in here to prohibit you from doing other things. And over time, they can change what the policies are going to be. And again, you may not agree with, you know, with some of these policies, but it's the old, she has the gold, she who has the gold makes the rules. And in this case, the government has the gold, they're making the rules. Now, the FAR, again, is only about, you know, maybe 2 inches thick, tissue thin paper, 6-point font. You couldn't possibly have all the rules in that. So you get supplements. So the DoD has the DFAR. The DFAR, when we first started doing this, was maybe an inch and a quarter thick. It's probably 2 inches thick now. So I guess the military's added a bunch of new regs. NSF has got a grant policy manual. NIH has got the grant policy statement. DOE, I love this, the DEAR. No, that sounds so Bambi-ish, but it's the Department of Energy Acquisition Regulation Supplement. And, you know, again, the various agencies have their supplements. So the point is, you're oftentimes not only responsible for knowing the FAR and its thousands of rules, but also the supplement for the agency where you have your project. This is an example where the supplements will differ from and even contradict the FAR. So this is out of the NIH supplement, and it talks about the what's required of your accounting system. Well, if you compare this with what I'll show you here in a little bit about what the FAR requires, it's quite different. I mean, there's some overlap, but there is actually quite a bit of difference in what's required in one versus the other. So where do you get the FAR, the DFAR? If you go to the local library or at the university's library and ask for the FAR, they probably will lead you to it. Now, if they do the deer in the headlights thing, they don't know what you're talking about, ask them for the CFRs or the Code of Federal Regulations. The FAR is part of the CFRs, and a lot of times they know the CFRs, and that's what CFR, excuse me, is what's going to get you to the FARs. You can also ask firms that have government contracts and grants. They probably have copies of this stuff. You can order your own copy from the government printing office. I get ours from the CCH company. It's about $100 for the FAR, $100 for the DFAR. I like paper because I want to hold it. I want to earmark it. I want to write on it. I want to you know, hold it in my little grubby hands and embellish, enjoy it. My wife prefers the internet version, so you can find it on various websites. Nice thing about the online version, you can keyword search. It also is updated on a regular basis on the internet versus obviously the published version gets stale pretty quick. And that's it for FAR, guys. But you know, I know some of you are disappointed. Some of you are really hoping for, you know, more discussion about FAR. So I do want to make you aware that there is a FAR immersion training program. that you could find online, and you can go in for a 5-day, 40-hour FAR course. Boy, talk about watching paint dry. I would rather do that. I would rather have, I think, my upper lip wax than to go through 40 hours of FAR training. But if you're really into FAR, look at that. They even offer this course at Vegas. Can you imagine that, man? Vegas and FAR, what a combination. So if you decide to go, send us a postcard, okay?
Jim, do you have
All right, so that takes us to the format of the cost proposal. Sure.
Question, yes.
Go for it.
Okay, great. So this first one asks, what agencies go with firm fixed price for their contracts or grants?
Oh, wow. I'm not sure I can give you a comprehensive list off the top of my head here. It's phase ones, the primary ones are the Department of Defense, NASA. People will argue that NSF is fixed price. Let me think of who else that comes to mind. Those are the major ones that pop up. DOE, I think, is fixed on phase one. So it's more common in phase one than in phase two. They'll change out of that. But usually a close read of the solicitation or the FOA they'll oftentimes say, phase ones are typically fixed price. And they usually add waffle language saying, it's ultimately up to the contracting officer, grants administrator. But the general rule of thumb is phase one, generally it's going to be fixed price. Phase two, they'll go to the cost plus.
Okay, very good. Thank you. And there's another question about salary, but you might cover this later. But it asks, for salary, can I use salary from a previous employer with some percentage increase as would be expected for education or more experience?
The general answer is that is not being considered reasonable. There's that term, reasonable, these days. They're really looking for, in the old days, people would say, look, somebody paid me this, therefore this must be reasonable, and you got away with that. But now what you're seeing are, you're seeing more and more of the agencies say, no, just because somebody pays you doesn't mean they knew what they were doing and that you were worth it. Prove that you're worth it. And more they're going to a published source. What is it? Salaries.com is one that I've heard people use, but the one that the agencies themselves point to and that I would urge you to look at is BLS, stands for Bureau of Labor Statistics, bls.gov, and just try to find a category in there that looks like something consistent with you. Also, look at location, or at least include some sort of cost of living differential if you feel like you're in a very expensive place.
Wonderful, thank you.
All right.
For now.
Okay, so we'll jump into the format of the cost proposal. Again, this is generally the format that you get into with the cost proposal, but you don't generally have to be as detailed as we got here in terms of the overhead versus G&A. As I'll show you later on, it's okay, particularly when you're getting started, lump everything in overhead and G&A into indirect, just called indirect, and then have the individual categories that we show on the farthest right side here. Allowability is a big part of this. So remember, this I told you not to worry about on the left side. It said all allowable costs. I said don't worry about it, just think about all costs. Now we're going to worry about, now we're going to think about what is meant by allowable. Basically, the federal government says, there's some costs we just ain't paying. We won't pay them. So those are expressly unallowed, and the FAR is the source of that list. Then there are those that they don't allow, not because the FAR says so, but because they put it into this particular contract. The agency has norms. There was particular legislation passed that affected their agency, or there's something else besides FAR that's driving that unallowability. Then there's what's allowed with limitations, and then kind of amongst the rubble is what's generally allowable. So let's look at kind of what's allowed, unallowed, allowed with limitations, and generally allowed. This is what the FAR says is not allowed, bad debt. So, you know, somebody didn't pay you, somebody stiffed you, you can't roll that loss into your indirect rate and basically make up for it by billing the government extra money. And I guess that makes sense. You know, on the other hand, it's got to get paid somehow, but you know, I understand the government's position on that. Number two, I do not understand. They will not pay interest on loans. Now you're going, wait a minute, that's not true. Every year when I write up my corporate tax return, I have interest on credit cards, and I write that off. It's allowed. Well, you're confusing the government with the government. See, you're thinking of the government as a taxing authority, the IRS, and you're right. The IRS allows interest on loans as part of your business expenses. The IRS does. But I'm talking about the government as your customer. And the government as your customer, which has a different set of rules, that customer says, I'm not paying interest on loans. So welcome to the world of government as taxing authority versus government as client. They have different rules. Sore point here, not only the inconsistency with the tax rules, but also government notoriously slow to pay. You may have to run up your credit cards to keep paying your bills, paying your people, and you're paying that 18% interest or 21% interest, and then the darn government that made the problem in the first place doesn't even allow you to write it off on your indirect rate. Legislative lobbying is kind of, you know, again, kind of understandable. They wouldn't want to pay for that. Number four, losses on other contracts, kind of like bad debt, right? It's like, you know, somehow you need to pay for that, catch up for that, but the government doesn't want to do it, and I understand that. Number five, legal organization costs are not allowed. So you write your proposal, phase one proposal, and you haven't formed your LLC yet. You get notification of award, and you go ahead and do the legal formation. The cost of paying the lawyer to form the LLC is not allowed. Now, the cost of maintaining the LLC and having the annual meetings and so forth, that is allowed, but the cost of actually organizing is not. And the thinking here is the government doesn't care that you're in startup mode. The government thinks you're a business, and a business ought to be already organized. And if you're not, well, okay, but we're not going to pay for it. Cost raising capital, not allowed. This is that same sort of theory. Well, you know, businesses that are really successful and in business, they don't have to raise capital. And it's like, where the heck do you get that kind of thinking? But that's their logic. So, you know, we're not going to pay for that because businesses don't have to raise capital. They have clients like us, and that's all they need. Well, that's, again, kind of a dumb way of looking at it, but that's how they look at it. So you can't charge the cost of raising capital. And here's the real bummer, number seven, because you will need alcohol, maybe something even stronger if you're going to deal with the federal government, but you can't have them pay for it. Now, that's that policy statement, right? We're talking about the FAR reflects buying unique stuff, and it also reflects public policy. Here's public policy saying the taxpayer shouldn't pay your liquor tab. I understand that, but from a practicality standpoint, it's a pain in the patoot because, you know, I confess the last time I ate out Friday night, I drank a beer and I got billed for the beer. And what it says is when I come back to the office on Monday, I've got to say, bookkeeper, take the cost of the beer out of this. We can't charge government for that. So you got to put that in another category. And so my bookkeeper says, okay, we're going to create a category, Jim's booze tab, unallowable. Okay, so we'll put that over there. Well, then the word gets around the office that, you know, hey, they're keeping track of Jim's booze tab. Now, I wonder you think he'll break $500 this month? You know, so again, I understand the public policy side, but the practicality is it's a pain in the patoot. Now, you want to see all the detail about these unallowable costs? You need to go see FAR, section 31.205-1 through -52. You're saying, wow, there are 52 different unallowable costs. No, there are 52 clauses regarding allowability, regarding specific categories of allowability. And you have to read all 52 of them to find those that are unallowable. So they don't have, here's the first 7 that are unallowable, then the next 20 are allowable circumstances, and the last 10 are expressly allowed. Instead, they just jumble all of them into 52, and you have to read through all 52. And there's in a NIH specific allowability list, you got a separate list you can take a look at down there. All right, so that was unallowed. What's allowed with limitations? Employee compensation, salaries and wages are allowed unless deemed, there's that reasonableness word, deemed unreasonable. And like we've been saying, BLS.gov is the best one to be looking at on that. I get this question sometimes, and I guess I've been in business for so long I've forgotten about these days, but people will say, wait a minute, you mean I can actually charge for my time on an SBIR? Yeah, I mean, that's probably what most people charge. 70 to 90% of their SBIR direct costs are labor. So yeah, you can get paid now. You've been working for free for a while, you can actually get paid. So you want to put that compensation in there, but make sure it's reasonable. Again, I'd recommend you look at BLS.gov. Appreciation allowed unless it's some bizarre write-off of major assets in 37 minutes. Insurance is allowed, but not on if you're creating a self-insurance pool. They're not going to pay for a pool, or I call it the Firestone clause, the cost to correct defective products. Patent costs are generally not allowed. Generally not allowed unless the contract itself requires it, or we're just talking about general legal services to determine a IP strategy. So if we're trying to decide how we're going to protect our IP and you're consulting with an IP attorney to do that, that cost would be allowed. But as soon as you say, okay, attorney, we agree, we're going to file a patent, please pursue filing that patent. As soon as you get a bill for that, you can't charge the government for that. They won't pay it unless you get it written into the contract. Now we're going to talk more about this because there has been some progress on this category over time here. Recruitment costs generally unallowed unless it's for government work. Rental costs allowed unless unreasonable. There's that reasonableness again. And what they look for is an insider deal where the guy or gal who owns the SBIR company also owns the building that they're located in. And they're going to ask, obviously, is the rental rate being paid by the SBIR company reasonable? Royalties allowed unless the patent is expired, which kind of makes sense, unenforceable or invalid. And travel costs, no first class tickets, no excess lodging and meals. But be clear on those travel costs. It's not that they won't pay anything towards the first class ticket if you had to fly first class because that's always available, or you got a broken leg and can't fit in coach, or it's the middle of the pandemic and you feel the least you're going to do is put yourself in a more widely spaced first class seat. What's not going to be allowed is the difference between first class and coach, but they will still pay for the equivalent of a coach seat. So it's not like you don't get anything paid for. And there you are, the same 52 clauses this stuff's going to be written into. Interesting, I think there's a slide that was at a glance. First of all, come down the first column, there's your 52 clauses, right? Second column, in a governmental language, that is what the cost category is. So it's not written like government, not written like business people would write, but it's government written language, and hopefully you can figure out which category you're looking for. And then the last 3 columns tells you, are those costs that are allowed? Are they allowed with restrictions, or are they generally unallowed? And notice by far the vast majority of costs are allowed with some restrictions, and you're going to have to look at the FAR clause to really understand what those restrictions are. IRAD, somebody was talking earlier about IRAD. IRAD, again, is research that you're doing internal. No contractor grant is a client on it. You're just doing it because you want to pursue, you're moving your project forward, your understanding of the technology. In my line of work, you know, I do webinars. So when I research a new webinar or I do updates of a webinar, my time spent on that is IRAD. Nobody pays me to update this stuff. I have to do it to maintain the quality of my materials, but I have to do it as myself as IRAD. IRAD is allowable and under GNA as long as it's reasonable. Unfortunately, some agencies don't allow IRAD. In particular, NIH and NSF don't allow you to build IRAD into your indirect rate. And that's one of those, you know, there's nothing in the FAR that says IRAD isn't allowed. NIH and NSF as agencies have said this is not going to be allowed. In fact, NSF claims that basically their entire SBIR program is IRAD because they didn't ask for these things that you're proposing. These are apparently ideas that you can't find any client to pay for, so you're asking NSF to pay for their development. So they're claiming their SBIR program is IRAD already. Patent costs, there has been progress in this category of, you know, is it allowed? Should it be allowed? And what I'm showing you here is an obsolete desk reference. So you really can't fall back on this because it's considered obsolete. But I gave you the quote because I think it helps you understand the argument that can be made. And the argument that's made is, in an SBIR, STTR, you may not know this, but an SBIR, STTR, if you develop any intellectual property with the SBIR, STTR funding, the government receives a royalty-free license to that IP. So anything you invent with SBIR, STTR, the government gets a right of free use, royalty-free use. This clause in this obsolete desk reference says, you know, basically by the government requiring this royalty-free use, they are implicitly requiring you to patent this IP because they can't have a right to something that doesn't exist. You have to formalize it. So you formalize it, or you can formalize it, let's say, as a patent. And that would also help protect the government's right to this technology and preclude others from having the right to it. So it's an interesting discussion. It's an interesting argument. This is going on for years. There's some agencies like the military that are quite receptive to you including patent costs in your proposal, your SBIR, STTR proposal. Department of Energy even says in phase 2, they'll allow you to write $15,000 into your budget specifically for patenting. And then there's an agency like NIH that says there is no way, no how, never are we going to allow the cost of patenting to be a cost in our SBIR projects. So it's, you know, it's a work in progress and more success with some agencies than others. Geez, do I really deserve a fair profit on my SBIR STTR project? Well, yeah, you do. You know, why? Well, first of all, theoretically, you know, your direct labor rate compensates you for your actual time. Your indirect rate compensates you for the general cost being in business. And your fee or profit in the free enterprise system is your reward for the risk of being and staying in business. All right, so there's your theoretical reason. It is your reward for the risk you incur by being in business. And you go, well, okay, I'm not sure they're going to buy that when I negotiate with government. What else you got? Well, okay, and pragmatic reasons. There's a real good chance you forgot to include something in your budget. You just didn't expect something, or you got in a hurry, or whatever the reason is, you left something out of the budget, okay? Or you actually incur higher costs than you expect because this is high risk research. That's kind of how you define SBIR STTR, is high risk research. Things don't go according to plan. So this helps you pay for the cost of correction later on, contingency, if you will. And it's also used to cover those unallowable costs a while ago. You know, you conclude you're working with NIH, you need the patent, NIH refuses to pay for the patent, you can pay for it out of profit or fee. And that's really the most important reason, number 5 down there, is you can do whatever you want to with the fee or profit. Anything you want to do with it. So if you're saying, you know, we are going to throw a Cinco de Mayo party in Little Rock, the likes of which have never been seen before, liquor will flow, things will be smoked, bond money will have to be paid, and we're going to use our profit to do it, you can do it. You're allowed to do that. You can do anything you want with your profit. Now, a real important rule you might tell from my example is you never tell the agency in your cost proposal how you're going to use the profit or fee, because as soon as you tell them, they may decide they don't agree with how you're going to use it. It's none of their damn business. They have no right to say how you're going to use your profit. That is your reward. That is your money. And I even give you the 2 quotes down here from 2 of the agencies, so you don't have to just take my word for it. The agencies themselves tell you any purpose. Use it for any purpose. So you want this money. Man, this is like, you know, on a $225,000 phase 1, it's like a $10,000, excuse me, a $15,000, you know, addition to your bank account with no strings attached. Do whatever you want to with it. All right. So what are the guidelines on fee or profit? 7% is the number that most of the agencies point to. They'll say not to exceed 7. They'll say typically 7. They'll say on average 7, around 7, but everybody's hanging in there at 7. So think 7% of the, and some will say 7% of the total grant amount or contract amount. Others will say 7% of the combined indirect and direct costs. But 7%. You see a couple of exceptions there, 10% at NSF, but only on phase 2s. Why? I don't know, because actually at NSF, I think phase 1s are riskier, and that's one of the reasons you get higher profit is higher risk, but they put it on the lower risk phase 2, so I don't know what they're thinking. Now, you also want to be familiar with the rules, because this is a place the government loves to trip you up in negotiations. I learned this the hard way. I call this tuition. I was on the phone one day with a contracting officer. There was an interesting relationship in that her husband had actually been the vice principal when I was in high school. So her family, my family, we go way back. So we're having, you know, a nice conversation about, you know, is Denny enjoying retirement, and, you know, how many more years do you think you'll put in, and how are the kids, and, you know, we're just having a fun old time. And she stops and she says, okay, so Jim, I can conclude our negotiation today. I can have a contract in the mail this afternoon, but you need to back off this profit request. I can't give you 7, I can give you 5%. Does that work for you? To which I responded, okay. Now, why would I have said, okay? Well, first of all, I forgot I was negotiating. I thought I was just having a conversation with an old family friend. No, I was in negotiations, and I lost touch with that, and that was a big mistake from the get-go. Second reason was I didn't know what to say. I mean, what's your comeback when they say, oh, we'll give you 5% instead of 7%? What's your comeback? Oh, yeah? Or I'm gonna go tell mom. You know, none of that works very well in government negotiations. So I didn't have anything to come back with. So I don't want you to get caught. This happens all the time because they love whittling you down on fee or profit. They dangle the carrot, right? You know, we'll get you a contract. You're almost there, but you got to back off. You got to give us this. So be prepared. They're going to try this on you. And instead of saying, okay, you say, well, I don't understand why you're trying to lessen the 7%. I mean, This is right out of the FAR, guys. If you look at the FAR clause, let me quote to you, for experimental developmental research work performed under a cost plus fixed fee contract, the fee shall not exceed 15% of the contract's estimated cost. So gee, I mean, the FAR says 15%, and I'm only asking for 7. It just wouldn't be reasonable to go down to 5%. Now, there'll be dead silence on the other end of the phone because it's like, oh crap. So, you know, they know where the FAR is and what the FAR says. Now I'm going to have to work a little bit harder here. You go on. Well, actually, let me say, I think probably this clause is not entirely accurate because FAR here is talking about a cost plus fixed fee contract. You are contemplating giving us a fixed price contract on a phase 1. Fixed price puts more risk on me. How do we reward risk in the free enterprise system? Well, that's by increasing profit. So, gee, this the FAR says 15% on a cost plus fixed fee. I bet the FAR would probably be tolerating 20% fee on a firm fixed price, don't you? Again, dead silence on the other end of the phone because you know you got them kind of backing up now. And you're not done yet. Well, and actually, I'm curious. You know, did you contracting officer? Did you go through the weighted guidelines of the Department of Defense used to determine what should be the correct profit or fee on a contract? You know, the one found in DFAR 215.404-4. I actually went through and derived the the profit rate for my company on this project, and I actually come out with about 22% on this. What did you get, contracting officer, when you did that? Now, I guarantee you the contracting officer will not have done this because this is a piddly low contract to them. They don't waste the time on that. So you have got them on the ropes now. Now, you might not get all the way back to 7%, but I bet you're going to get a heck of a lot closer than 5%. Plus, you'll have the satisfaction of beating them at their own game. Okay. And by the way, and this is great, not only does DoD
Jim, from my end, it's you're cutting out a little bit with your audio. I'm not sure.
Have literally a means of determining what should be the profit or fee. Okay, not sure either. Well, maybe this would be a good time to go ahead and take our break. And interesting. Okay, why don't we go ahead and take our break, and that'll give me a little bit of time to see if we can figure out why that's happening. So I've got 10:32. Let's come back at 10:42, and we'll continue on.
Thank you, Jim. It's just every now and then it cuts out, so we miss a few words, I think.
Okay, let me see if our other system, our other, well, that's interesting. Okay, all right, we'll give it 10 minutes to rest. All right, thanks. Okay, let's get started again. Hopefully our internet will behave itself. Rebecca, please keep me informed if it cuts out. We'll make changes here.
Sure. One person said that the cutout seems to be happening when you switch displays, so that could be just a small thing that's tied into it.
Interesting. So like when I change from slide to slide? Okay.
We do have some questions, but we can hold off until we get a good stopping point for those.
Actually, I think we're probably okay if we want to do here.
Okay. The first one asks, can you go a little deeper on NSF not allowing IRAD costs?
Don't know what else I can tell you. They just disallow it, and the rationale is that because their program is entirely open, you can submit a project on any topic. They're treating that as IRAD itself, because they're saying, gee, if you had a client that wanted this done, then you would have gone to them to pay for it. And since you apparently don't have a client, you came to us in NSF, so you're basically already getting IRAD from us because, we're paying your internal research and development because no client's willing to pay for it. So that's kind of the rationale. And then, I kind of understand what they're saying, but I also don't agree with it. But, doesn't matter what I think. It's the old, she has the gold, she's making the rules. But that's all I can really tell you about it.
Okay. And one person asked if we have working software and all we need is a phase 2 to harden it for security, then the government can use that royalty free?
Not exactly. Now, I should preface by saying I'm not a lawyer, never have been, never want to be one, but what I would say is whatever you bring to the project that you have previously done, the government does not have rights to that. What they have rights to is what you do with the SBIR funding itself. So what people will do, again, I'm not a lawyer, but what people will do is before they accept the SBIR STTR funding, they will file, say, a provisional patent to kind of distinguish what existed prior to accepting this government money. And that helps make it clear what the government has a right to and what they don't have a right to. Now, having said that, there can be issues where you're including something in the SBIR project that you have previously developed, and it's hard to segregate that out and to clearly define what what lines of code previously existed as opposed to which lines didn't exist. So it can be a little bit more tedious in practice in terms of making this distinction. But at least if you can make an effort, two things: make an effort in advance to distinguish what existed prior to the project, SBIR project, and number two, again, realize that what they have rights to is what you do with SBIR, not what you bring to it from other sources.
Okay, great. The last question asks, are PIs responsible for contract negotiations?
Usually it's the government official, the company official. And if you're like the person a while ago that's a one-man operation or one-woman operation, then that's you. You're the CEO, the CFO, the CTO, and everywhere in between. So you're negotiating. If it's a little larger company, sometimes it's better, in my opinion, to separate the technical and the administrative personnel on this, because and I don't want to get anyone's knickers in a wad here, but sometimes technical people feel I'm a brilliant scientist, I'm about to do something incredibly beneficial for the warfighter or for cancer victims or whatever it might be. Who the hell are you, government, to stand in my way with all these stupid rules? And if they come in with kind of that attitude, they can get real crossways with one of these bean counters who, quite frankly, believes they're the center of the universe. In fact, you'll hear the term, you'll sometimes hear the term COTAR, CTOR, COTAR. COTAR stands for Contracting Officers technical representative. And if you think about what that means is the contracting officer is the bean counter, and they are saying the technical people in the agency who want this work done, they're merely representing the contracting officer in the project. So if you have that sort of situation and your technical people are just really not receptive to dealing with bureaucrats and issues of budgets and FAR rules and that sort of thing, then maybe it's better to have somebody else on the team do the negotiations. Was I diplomatic enough in that? Did I work my way through that?
I think you got it. Thank you, Jim.
Okay. All right. Okay. So let's press on. So again, ask for profit, ask for 7%. Be prepared for them to try to whittle you down, and have this documentation we've given you to defend yourself. No, okay. Let's see what I did. It's telling me. Hey, Jim, you got to put this back on slide mode. There we go. Okay. In some cases, the agencies don't want to pay for any equipment in phase one. So NSF says, we're not even going to allow you to buy equipment in phase one. And NASA even doesn't allow it on phase two. Now, I kind of understand the phase one argument, which is, this is just a feasibility study, small company. You don't even know if this is going to work yet. Why should we be buying you fixed assets worth, $10,000, $20,000 when it may be for naught if the whole project doesn't work? But if you do buy equipment, and very important caveat at the top of this slide, if you buy it as a direct cost, remember our whole life-changing discussion of direct versus indirect, if you buy it as a direct cost, so it's a line item you've called out in the budget, it turns out that in some agencies, primarily the contracting agencies, they don't allow you to own the equipment. So you put it in the budget, it's for your project, you justified it, they give you the money, you buy it, you use it, you don't own it. The federal government retains ownership. You say, what do I care? Well, it's important because your accounting system, you got this thing called a balance sheet, in which case you show all of your assets. You can't show this piece of equipment as an asset if you don't own it. The granting agencies, and these tend to be like NIH, NSF, USDA, the ones that make their awards as grants, they tend to give you ownership, because the last thing they want is a warehouse full of crazy looking equipment that they could not do anything with. So this is an issue, again, if you are buying your equipment as a direct cost. A, do they allow it? B, do they own it if I do buy it? By the way, even if they do own it, sometimes by the time you get through, say, phase two, you can argue that it'd be advantageous to the government just to assign ownership over to you, that it's not worth them reclaiming it. So even if they do own it, there is sometimes at least an opportunity to gain it long term. Now, if you don't want to have any question about owning the equipment, you want to own it, period, then don't put it in as a direct item in the budget, but instead you can either pay for it as part of your indirect costs through a depreciation expense, or you could pay for it through your fee or profit. Remember, you can do whatever you want to with your fee or profit, so you could buy the equipment and own it in that case. Type of payments, agencies are getting more creative on this. The two choices used to be advanced or progress. Advanced means you get paid money in advance of doing the work. So you get money before you start the phase one, you get money before you start the second half of the phase one, you get money before you finish the phase one. That's an advance. Progress would be you work for a month on your phase one, send us an invoice. We'll lose it, send us another invoice. We won't like it, send us the third invoice. We might pay it 90, 120 days later. Then you send the next invoice. Which do you prefer? What sounds good? Most people say, wow, that advance sure sounds a lot better than progress because they get paid in advance, not sometime in the future. Okay, well, most agencies don't allow advance. So that's probably not a choice. So you go, okay, so great. So really advance is not a choice. I guess I have to choose progress. Oh, but if you choose progress, man, you don't want to choose progress because progress is going to trigger an audit because it means you have to have an accounting system suitable for tracking progress, and the government's not going to just take your word for it. They're going to come out and see and have you prove that your accounting system is capable of showing progress. You go, so let me get this right. I've got a choice between advanced and progress. They don't allow me advanced, and progress is not anything I want. So what do I choose? Well, you know the old saying, when confronted with two choices, pick the third. So you got the choice of advanced versus progress, choose partial payment. Partial payment means, and let's take a real simple example. Let's say you bid or you agree on $140,000 phase one, and it's a 6-month project. Well, partial payment means they will pay you $20,000 a month towards this project, phase one project, regardless how much work you do that month. So it's not tied to progress. You may make incredible progress, they still get paid $20,000. You may do nothing and you still get paid $20,000. So it's partial, it's not a progress payment. So you get paid $20,000, you go, well, how do I get my 140 if I'm only charging $20,000 and it's a 6-month project? Well, that means you're going to get $120,000 in partial payments, and the other $20,000 will be held back until you file all your final reports. So partial is what many people will request, and it's kind of a compromise between, you know, you can't get advanced. Progress is going to trigger audits. You don't want that. Partial is better than progress. All right. Anytime you're dealing with the government, contracting officer, auditor, tell them what they want. You never hide or lie about anything, but also you never tell them any more than you were asked to provide. So if they ask to see a timesheet, only show them a timesheet. If they ask to see a demonstration of the reasonableness of one of your labor categories, only show them the reasonableness of one category. Don't show them the reasonableness of all your labor categories, because when you show them more stuff, it's more likely there's going to be something they have questions about, and they'll continue to ask questions. So just give them the bare minimum. All right. So we're going to shift gears here for a few minutes and talk about, you know, what do I have to do if I get one of these awards? What's required? First of all, make sure you got your accounting system up to snuff. And part of that's going to mean take your accounting system as it probably exists and determine where you need to show allowability versus unallowability. And so that you can isolate some costs as being unallowable for purposes of the federal government, your customer. Now, remember again, what's unallowable for the federal government as your customer is not necessarily what is allowable or unallowable per the IRS. So you want to make it smart enough in your accounting system that it understands it's unallowable when you're calculating your costs and so on for the government as a customer, as opposed to as a taxing authority. And then within what is allowed, again, we need to differentiate direct versus indirect. So this all goes into your chart of accounts. And frankly, that's where a lot of time needs to be spent. People, I think, underestimate the importance of the chart of the accounts, because this is the listing of all the accounts in your accounting system. If you don't have the right accounts in there, the whole system doesn't work right, and it's going to be very frustrating to try to figure out where to put stuff when you don't have categories to put them in. So start with your chart of accounts, get that kind of into shape, and that should help you with as you go forward from there. Other thing you got to do, and I'm the bearer of bad news here, but that's, you know, that's my job. That's why I get the big bucks here. You need to be keeping timesheets. You going, what do you mean I need to be keeping timesheets? Well, you know, most of what you do on SBIR is labor, tends to be labor. Some contracts even reimburse you on the basis of labor, something like a cost type contract. And frankly, the government wants to know how much labor you're putting into direct and how much labor you're putting into indirect, because that tends to be a big part of your indirect rate and justification for your indirect rate. So bottom line is, I think this is my next slide, everybody in your company needs to be keeping a timesheet. If you have an SBIR, an SBI, or an STTR project, it can be a contract, it can be a grant, it can be with any agency, it can be phase one, you should be having everybody in the company keep a timesheet. Now, you're probably the president of the company laughing, going, oh, that means the poor schmucks that work for me are going to have to keep timesheets. No, Madam President, you're going to have to keep one too, because you're probably sucking up a lot of indirect costs, and you have to show that allocation of your time between direct and indirect and how many hours you put into indirect to justify your indirect rate on your SBIR project. So everybody in the company needs to keep a timesheet. The only exception that I've seen is if you got a company, say that's primarily a manufacturer, and you're now going to get involved in some R&D through SBIR, then the manufacturing side of the shop can be let off the hook and not be included because they're not involved in the costs of the R&D portion of the company. But otherwise, pretty much any company that's got an SBIR, STTR should be keeping timesheets. And this gives you some of the requirements, unique codes, track things down to the quarter-hour increments, make sure you're signing it, make sure the employee's signing it, make sure you're filling it out in ink. Although most people now will do it online, whether it's an actual timekeeping package, or a lot of people just use Excel to track it. But again, it's easier to put on Excel because then you're not having to do all the additions and math. A real simple example of a timesheet, again, you'd have to do an awful lot of filling in here because it's just a skeleton. If you don't keep timesheets correctly, the employee is at risk for putting in false information, supervisors at risk for signing off on a timesheet they know has false information, and managers and officers of the company, if they know that timesheets are not being kept accurately, are at risk. What are your penalties if you're caught falsifying timesheets? You can be suspended from federal procurement for a few years. But the really tough one is the second one, when you could be facing prison time. You go, they wouldn't do that. You want to bet? You are betting, because that is part of what you are facing is prison time. And the government is not above, because they've done this a couple of times in recent years, they're not above putting a couple of SBIR recipients in jail to kind of get the word out to everybody else that they need to clean up their act. So, if you want to be the one to take a bullet for the team, God bless you, but you don't have to do that. You just need to do your job right and keep timesheets accurately and make sure your people keep their timesheets right. Part of the concern, and this is lesser concern today than it was a few months ago, now that the economy is kind of righting itself, but there was concern that whistleblowers were going to use what they believe to be falsification of timesheets in SBIR companies to lead to charges against the owners and employees of those companies. Again, hopefully that's a little less prevalent now because of the improved economy, but we'll see. Another thing I would caution you against, anytime you see the word certification or certify, I certify that. This is a term in federal government that basically says you are swearing on your grandmother's grave that this is the truth. And if it is not the truth and you lied, we're coming after you with sanctions up to and including prison time. So anytime you see certification, or again, certify, I certify that, all right, this is certification that, don't take that lightly. And some of these, I certify I'm in compliance with FAR clause 15.204-12. You probably have no idea what that is. You better go look it up and make sure you feel comfortable that you are in compliance with that. There have been some instances, not widespread, but some instances of government representatives, let's just say they're in the IG's office, Inspector General's office, that's the police department at the various agencies, who have, in my opinion, tried to trip up SBIR company owners by having them certify certain things, and then come in later to confirm that they were not meeting what they had certified they were doing and filing charges against them. I will say the NSF and NASA were two agencies where I think that was most aggressive. So if you are dealing with NASA or NSF, be especially wary of anything you have certified that you are in compliance with it. Some people have decided, just to avoid all the hassles with being sued and all, I'm just going to treat everybody as an independent contractor. And of course, you probably know you can't treat everybody as an independent contractor. And there's actually a 20-question survey that the IRS will use to determine if the employee or the individual in question is truly an employee versus an independent contractor. And these are the 20 questions. Important to note that just because you get mostly columns in the second, or excuse me, check marks in the second column, doesn't mean majority wins. So just because you get 11 out of 20 check marks in the second column doesn't mean the IRS is going to conclude they're an independent contractor. And I made this point again, FAR and IRS are kind of two different perspectives on the government and what they want out of your accounting system and what's allowable and so on. Got to be in compliance with both. And the fourth point, very important, you don't want two sets of books. You don't want a set of books for the IRS and a set of books for your federal clients. Instead, you want a set of books which present the data differently using different templates, so that if it's a template for the IRS, then it would show it would show what the only half of meal expense. Although I guess if I understand right, we were given full meal expense as a write-off during the pandemic. I think that probably ends here pretty soon, but very traditional source where people did not get to be able to write off all of that expense. If you got a subcontract, please have an agreement with your subcontractor, with your consultant in advance. What work are they going to do? What's the compensation? What are their IP responsibilities? Get all that in place ahead of time. And include what I call as a flow down clause, which basically says this sub or consultant agrees that anything you are subject to as the grant or contract recipient, they are subject to. So you don't end up with them claiming to not have to comply with the rules because they're a subcontractor. Okay. Rebecca, questions, or can we move into our format of our agency cost proposals?
We do have one question, and it asks, can you recommend an accounting system that works for FAR and IRS cost tracking?
Well, most people that I know of use QuickBooks. They use a version of QuickBooks. Online QuickBooks was not allowed or not favored there for a while, and I think it had something to do with being too easy to modify without having proper controls. But I haven't heard that recently, that concern. A few people use something called Deltek, which is a government accounting package, which if you get the full-blown version, it's something ridiculous like 50 grand or something. And they've come up with a little SBIR version, which is like 5 grand, I believe. But again, most people do something QuickBooks related. And then it's just a matter of setting up the chart of accounts right and making sure you've got controls over who can make changes to entries and that sort of thing.
Very good. Thank you.
All right, so let's look at the cost proposal format for the three larger agencies. So you got some idea of what they're looking for. This is what the military used to use. Now, I wouldn't say this form was used for a long time, but Davy Crockett did use it to buy muskets in the old days. So it was around for a long time. Then they upgraded to this one, and I really liked this one. This was a great form because it was a smart form. You put in some information, and it would carry that information through the form, every place that it needed to be put in. It was great. And plus, just visually, you can sit here and you can kind of see, it's a phase one project, but then there's room to put a phase one option next to it. And there's a direct labor, it's called direct labor because you'll see some of the forms don't differentiate direct from indirect labor. So a really nice form. So you know what the military did. They did away with the form. You don't see this form anymore. This is the second page of that form. This is actually an example of what that would look like if you use that form. And now is this template, and you go on and you're checking boxes. So what are the components that you have? You have subcontractors, check that box. You got materials, check that box, and then you hit continue, and then it asks you about each of those boxes, and it just just works you down through. Here's a labor category. What's the person's name? What's their category? What's their level of education? And it's like, who asks? Why are you asking that? I don't know why they're asking that. I don't know where that would come up in the cost proposal, but this template asks you, what is their level of education? And it's a required question because it's got the little asterisk next to it. And you just go through this dumb form with really no idea, this template with no idea where all this information goes, what it's used for. So this thing is a dud, in my opinion. It's in terms of actually deriving your budget and putting it into a form that it makes sense. So I think what you're trying to do is get back to something that looks like this. Now you could plug this into and kind of create this if you wanted to, or there are a couple of components. This is on Excel, and you can do it, but this is cost proposal worksheet on steroids, because if you look across the bottom, look at how many tabs there are, how many different sheets there are on this spreadsheet, and you really don't need all that to just do this. So up to you. You could put this all on Excel and probably put it all an hour, or you can use this guy and spend that half hour trying to figure out how to use it. Ultimately trying to get to something that's going to look like this with direct labor, then direct materials, other direct costs, and fee or profit down toward the bottom down there. Important, this example shows a fringe rate, a labor overhead rate, a material overhead rate, an other direct cost overhead rate, and a G&A rate. So this is really out of control, in my opinion, in terms of all these indirect rates. I think, particularly those of you getting started, you don't have to do any of these fringes or labor overheads, just material overhead. You could go all the way down, and where it says G&A, which is about 4 lines from the bottom, plug in a single indirect rate there. And when we do our exercise next, I'll show you that's the single rate. That's where that single rate would go in that example, is under G&A. Okay. So keep that in mind. Your actual cost proposal does not have to be this complicated in terms of all the overhead and fringe rates and so on. And again, this thing is, in my opinion, of no help whatsoever. It's just once you've got this, volume 3 cost proposal. All right, this is for grants.gov, and this is an updated version of the grants.gov form. You're starting out with your senior key persons, and you are actually only, and very important point here, only where you're seeing red boxes are where you have to enter data. So you don't have to enter data only where the red boxes appear. And this does that every time I hold on here. There we go. So you plug in for the first value $50,000, fringe benefits 0, total funds 50,000. Then you click on add additional key person, and it brings up another blank. Then you would add Juan Garcia, requested salary 75,000, fringe benefits nothing, 75,000, and keep clicking on add additional key person to build up the total number of key senior persons that you've got. Then you got other personnel, which is kind of an interesting distinction. You know, it's kind of the key people are the ones that are crucial to the project. Other are, you know, they're helpful, but their contribution is not large, and or their qualifications are not terribly unique. Now, it's not telling you anywhere in this form, but important to realize sections A and B are only for direct labor. So it only says senior key person. It doesn't say direct labor senior key person. It says just a senior key person, and doesn't say other direct personnel. It says just other personnel, but both of these are only direct. So that suggests under item B, where you see postdocs, grad students, undergrads, you probably don't have those in a company. You might have a secretarial clerical support person, but only what you put in this part of the form is their time working on this project. So if they're entering data, say from a survey into a database, then that time would be included here. But if they're just performing their routine secretarial clerical duties, then no, they would not be here. Then equipment. Again, does your agency allow equipment purchase in phase 1 or not? Indicated here if you do. Travel, you know, some of you will be required to travel to DOE Department of Energy headquarters, for example, for all phase 1 recipients to attend a meeting. Several of the agencies have similar requirements now. Section E is generally not used in SBIR STTR. It's basically for human subjects, and you are paying them a stipend, you're paying for their travel to the study site, you're paying meals and lodging while they're you know, doing some work for you, but relatively few projects will have anything for Section E. All right, then Section F is kind of nice because they give you some categories that you might have forgotten about, like equipment rental, publication costs, and this is also where you will put your consultants versus subcontractors. So consultant line 3, subaward line 5. The basic difference, and this is not a hard distinction, but some of the agencies will make this difference. Consultant is a person. Subaward or subcontractor is an entity. So if you have an individual joining the project that's not an employee, that go under consultants, line 3. If you have a company or university or federal lab or something joining the project, then you would put them under line 5. But again, that's not a hard definition. Sometimes they talk about consultant on line 3 being someone who advises versus line 5 as they're actually doing work. And being a consultant, I don't know that I really appreciate saying advice is not working, but whatever. And notice also you get some blanks, lines F8 through 10 also allow you to put in some categories that aren't shown. So it's kind of a nice section F. There's some pre-populated to remind you of things that you might have forgotten, but also gives you some blanks for other. Line G summarizes everything to this point. Sections A through F get summarized in line G. Line H then will be your plug-in of indirect rate type, which will be, could be as simple as just saying indirect cost. You could just say that, or indirect rate. And then you have indirect percentage. You have to plug this in, and that's what we're going to do in our exercise here in a few minutes, would be that rate. Then you have to say, you know, what is the base? What do they mean by base? Well, the base is, what are you multiplying this rate on? So if this rate is 63%, 63% of what? And 63% of this number, and this number should either be line G, so total direct costs above that, or it should be the combination of lines A and B. And if you go, or sections A and B, excuse me, if you go back to sections A and B, those are your direct labor. So indirect rates are generally done as a percentage of all direct costs, again, which would be line G, or percentage of just direct labor, which would be sections A and B. It will summarize then the total of your direct and indirect, brings you to a subtotal. Your fee gets added on top of that. Now again, very stupid, this form, it doesn't ask you for a percent. You have to get your little HP calculator out and take the number from line I and multiply times 0.07 and plug that number into line J for your fee, and then it will come up with a total for, which hopefully then you have ensured does not exceed the maximum allowed by the agency that you're submitting to. Excuse me, then you'll attach a line L, your budget justification, which explains how you got all these numbers. So this is grants.gov. This is what we're going to use with NIH, going to use it with Department of Energy, use this with Department of Agriculture, USDA, and I believe both NOAA and NIST are using the form, the grants.gov form now. All right, so that'll be year number one. Add period simply says, boy, if this is a multi-year project, like a 2-year phase 2, you would click on add period, and now you would do it for the second year. And as you do that, you'll repeat exactly what you've just done for the second year, and this cumulative budget page will keep track of all of that so that you know what the total for the entire project is, not just for the first year and then the second year. All right, finally, NSF. This is NSF's budget form. Interestingly, as you look at it, it has a lot of the same categories as grants.gov. So we got senior personnel up there. Now remember, it was key/senior personnel under grants.gov, and then section B, and it's section A, section B, section C, just like grants.gov. Section B is other personnel and includes postdocs, grad students, etc. So it looks a lot like grants.gov, but it's all on one page. So nicely, it's all just kind of put together. Where you're seeing yellow on this slide, those are the values that you're to be plugging in. Anyway, that's, and I guess they've given you, actually, it's hard to read some of it, but they've given you an example within this for at least some of the values. So interestingly, that's, why do they do that? That's interesting. They only plug in, this is really kind of dumb, they only plug in a $40,000 amount for consultants, and then under section I, they plug in 120,000 at 40%. Why do they do that? And then they put a fee down there. Very strange. They didn't, I mean, it doesn't have any labor in it or other costs. It just jumps into those categories. So it's a weird little template here. I'm not sure what they're trying to show with some of this template being filled out. And this is kind of what that will look like when it got completed. This would be an effort. Okay. NIH is the one agency that has really gotten adamant that on phase ones, you cannot request indirect costs more than 40% of your total direct costs. So if your cost of doing the research in phase one is, we'll keep it simple, $100,000, then they will not allow you more than $40,000 more dollars to cover your indirect costs. Now again, that may sound like a lot of money, but trust me, it's not on a project like this. And particularly if you're a small company, and particularly if you're a startup company and you got a lot of indirect costs that you're paying. And worse yet is phase two, then they'll hold you at that same 40% unless you're prepared to negotiate. And I would encourage you to do that. And again, I would suggest that once we do the exercise here momentarily, you could negotiate successfully. One that really stinks, in my opinion, is NSF has an option where they'll let you get 10%, a lousy 10% rate. You know, if I'm bad mouthing 40%, imagine how I feel about 10%. You know, this is going way in the wrong direction and not allowing you to really be compensated for your costs being in business. Okay. Exercise time, unless, do we have any questions, Rebecca, before we jump into our exercise?
No questions at the moment.
Okay, all right. So either people are numb at this point, or completely dazed, or we're just making such incredibly crisp comments that everything is crystal clear. We'll take the latter for our explanation.
Yes, I agree. Oh,
all
wait,
right.
Someone just asked a quick question.
All right.
What was the suggested template? Because the sound cut off when you mentioned the suggested template, apparently.
The suggested template. The only templates that I think we talked about in that were the ones for DoD, and you've got either Navy or DARPA, and they're both more complicated than you really need for phase one. I think personally, I think you're better off taking that example of the DoD budget and just putting it into Excel, a simplified version of that into Excel, and do it that way. And then once you get the numbers as you like them and you agree with them, then you can plug them into the, maybe that was what they were saying. The other template is what, when you go to the online submission, the DoD's online submission under DSIP, you enter the cost proposal one line at a time, like we were showing, one number at a time. So you want to do the entire budget on an Excel spreadsheet, in my opinion, and then you go to that template for entering the information into volume 3 of your DoD proposal.
Okay, great, thank you.
All right. Okay, so remember this exercise is based on a little 4-person company, new company, and they're running their first SBIR proposal, and they want to submit their phase 1 proposal with a good cost proposal, including an indirect rate that is accurate for their business. So in doing this, I want to show you how you'd go about doing this, and then you could follow this example in deriving an indirect rate for your company. Again, we do this per the text box. You do this for a year's time. So you could do this now. We're almost the 1st of June. You could do this for federal fiscal year 22, which will start October 1st, or you could do this for calendar year 2022 if you want to. That's probably a little further out than you want to be, but you know, the point is you don't do it for today and you don't do it for the next couple of months, because you're going to be submitting a SBIR proposal that even you got to wait for the deadline to submit it, and then you got to figure probably 3 or 4 months after that before you'd get underway. All right, so we calculate our indirect rate, and we calculate our indirect rate, this is important, for the entire company for the entire year. So some people think you do an indirect rate for just a project. when you're submitting a proposal. Wrong, dead wrong. You develop an indirect rate for the entire company for an entire fiscal year. All right, so we start out with calculating paid absence. We're going to give our employees some time off. We want our indirect rate to capture that. So, and this to the individual's earlier question about I'm working more than 40-hour work weeks. Notice here I'm using 40-hour work weeks. This would be where you would adjust, one of the places you would adjust to say 50-hour or 60-hour, whatever you're going to work, and do these calculations on that basis rather than 40 hours. But assuming a 40-hour work week, the annual work year is 52 weeks, 40 hours a week is 2,080 hours. We're going to give our employees 10 days vacation. That's 8 hours a day. Again, if you're doing 50-hour a week, then that'd be 10-hour days instead of 8. But if they're 8-hour days, that's 80 hours. 10 holidays, that's 80 hours. Sick leave used, and this is an estimate of how much time each employee is going to be sick during the next year. Good luck estimating that in advance, but you have to take a stab at it. We're going to assume the average employee is going to be sick a week, a year. So that's 5 days, 8 hours each day, that's 40 hours. So we sum that up, our employees are going to be absent from the workplace 200 hours a year. 200 out of the total work year, 2,080 hours, is 9.62%, almost 10% of the work year. Now, every time I do this calculation, I'm amazed that a measly 10 vacation days, 10 holidays, and 5 sick days adds up to 10% of the work year. Just doesn't seem like it should be that much. Now, take the anticipated salary of each of our 4 employees for the coming year and multiply that times this 9.62% that we just calculated. So for Smith, we're anticipating Smith earning $50,000 that year. 9.62% of $50,000 is $4,800. Put another way, Smith is going to earn $4,800 of her salary while being absent from the workplace. Then you repeat it for the other 3 employees, and then tally it up. And that means our paid absence policy is going to cost our company $16,000 next year. All right, set this number aside now. Now, how will our employees spend their time during the coming year? Now, this is a little crystal balling because you don't know. I mean, you're a startup company. It's hard to know even as an established company what you're going to be doing in the next year. It does get easier, I admit. And also it's easier when you're a bigger company because you tend to have multi-year contracts. But you just got to do your best here, guys. This is doing the best you can to estimate what your costs are going to be next year. So just take each of your 4 employees and just say, based on our business plan, based on our current marketing efforts, based on the proposals that we have submitted and anticipate submitting, how will our people spend their time during the next year? Smith, we hired Smith with one purpose in mind, for her to work projects. She's got an incredible technical background. She is exactly what we need to work these projects. We want her working 100% of her time on projects. Guys, it is impossible to work 100% of your time on projects. I see this a lot in cost proposals, and it's an error because it is impossible to work 100% of your time on projects. Why? Well, you're sitting in this webinar right now, you're not working on a project. So there's an example where you're not 100% on projects. Going to a staff meeting, that's not project related. Help write a proposal, that's not project related. Answer some emails, probably not project related. So I'm showing Smith 90% of her time working on projects, 10% not working on projects. Incredibly aggressive assumption in terms of how much she could work on projects. Why? Well, think of 10% of a person's week. 10% of a 40-hour work week is a measly 4 hours. Do you really think an employee can spend 4 hours or less the entire week not working on a project? Very aggressive assumption. So 80%, 20% split between direct and indirect is probably a better upper end for an employee, but we'll go with this one. We'll make this more aggressive. So we assume 90% of Smith's time on projects, 10% of her time on indirect. Take that 90% times her anticipated salary of $50,000. That puts $45,000 in the direct column, puts $50,000 in the indirect column. Garcia, president of the company, about 60% of his time on projects, 40% of his time on indirect. Split his $65,000 salary into 40 and 25. Zukai is kind of an 80-20 split between direct and indirect. Split their salary of $30,000 into 25 and 5. And Williams is the clerical support person, the only person who works predominantly indirect. But even this person is working 20% of their hours on projects. And again, 20% of their salary goes in, $5,000 goes into direct, 80% of their $25,000 salary goes in indirect. Now do the summation. Total salary is $170,000, of which $115,000 is earned while on direct projects, and $55,000 is earned by employees while they're working on indirect. Make sure the 150 and the 55 equal to 170. Make sure we've done the math correctly. And we have. All right, you've done the math correctly, but you know what you haven't done? You haven't cut out a very important overlap. The overlap is, remember back here, we said, 9.62% of the time, these employees aren't around to do anything. They're not in the workplace. This says they're there 100% of their time, doing either direct or indirect. So we've got an overlap between our paid absence and our allocation of direct versus indirect. The way I handle that is to come back and say, all right, salaries, 115 and 55 between direct and indirect, remove or discount, subtract 9.62% of that amount. So 9.62% of 115,000 is $11,000, round numbers. Subtract it, we get about 104. 55,000, subtract 9.62% of that, it's about $5,300. Subtract it, we got about 49.7. So again, do the summation, total salaries, 170, right? We've discounted by 16,354, which is conveniently exactly equal to the paid absence, which is what we wanted to do. And then the discounted amount, 3,646. If we add that to the discounted amount, again, we get the 170. So now we've taken out the overlap. Excuse me. Now we calculate our other indirect costs, or fringe benefits in this case. Here's where we would estimate the employer portion of payroll taxes. Now I've simplified this. In that some of you may know that Social Security, there's a combined 7.65%, but actually there's a 1.45% on Medicare, and there's a 6.2% on Social Security. I've lumped it all together into a combined rate of 7.65 because nobody in this company earns so much that they're above the point where Medicare is no longer required. So I think unless you're paying more than, it's like $125,000 a year, you won't have to do that split. You could combine as I did here. Federal unemployment is 0.6% of the first $7,000 per employee. So we got 4 employees times 7,000, that's $28,000. 0.6 of that is $168. Excuse me, state unemployment tax is actually subject to your state and your company. So new companies starting out, a lot of times they'll start with a rate of 2.7%. I'm not quite sure why, but that's a very common startup company rate. Then as you get more mileage on your company, that rate can go high if you have a lot of unemployment claims, or it can go lower if you don't have very many. So I use 2.7%. Now the $9,200 amount that I'm showing, that also is subject to what your state does. If Arkansas's rate is $9,200, then this example fits you exactly. If your rate, if Arkansas is different, then you need to adjust that. So if I were doing this for my home state of Florida, state unemployment tax is a percentage of the first $7,000. So I would have to modify this number for that. So I add that together. That's about $14,000 in payroll taxes I've got to come up with as a company. I'm going to do some employee benefits. I'm going to do a cafeteria plan or flexible benefits plan in which everybody in the company gets 5% of their salary in benefits. I'm going to do another 3.5% on retirement, and those two benefits are about $14,500.
We have a couple questions, Jim, if you have a second.
All right, this looks ungodly. Okay, all right.
You mentioned earlier all projects, and someone asked, would all projects include IR&D?
All projects. I'm trying to remember what the context was.
Might have been a couple
I
slides.
said all projects. Well, let's go back here. Were they thinking here maybe direct versus indirect?
I believe so. It was about the time it came in. Or yes, it is. The person said its percentage of time spent was what he was asking.
If it was better than IR&B, okay, IR&D would be indirect, would be in Smith's example would be part of their 10%.
Okay, very good.
So direct side's only if it's outside client. So IR&B will be IR&D. I don't know why I keep saying IR&B, but it's IR&D would be in the indirect side.
Okay, great. There was one other question that asked, would the estimate of value...
All right, this looks ungodly, but it's really not that bad, guys. It's the... Oh, okay.
Sorry, Jim. This question before we move on, would the estimate of value of paid absence be calculated differently for each employee if they receive a different number for weeks vacation?
That's interesting. You know, every time I do this slide, I always explain that, and then this time I thought, well, nobody ever seems to question it, so I'm not going to bother to explain it. So the answer is yes. So you would take this slide and modify where I show 9.62%, change it by adjusting this slide. So if vacation earned is 10 days a week, then this number of 9.62% works. If it were 12 days vacation, then you would adjust up to 96 hours vacation, and it would be a higher percent. That higher percent would go against the person's salary here. And if it's somebody with 3 weeks vacation, then it would be even a different rate. So that's why I broke it out on this slide by employee, so that you can adjust the paid absence percentage by employee. That's funny though, that nobody ever asked, and I just didn't bother to address it and see somebody else. So.
Related to that question, a person just asked, why not list the cost of the time off? Right. This related question says, why not list the cost of the time off vacation in the fringe benefit cost rather than considering it in the direct labor cost determination?
I guess what I'm trying to do is, well, I'm not quite sure the question as it pertains. Let me see if I address that when I show the example here. I think I know what they're saying, but let me see if I address it when I get this example here.
Sounds good.
And what I'm doing is showing in this example, and again, the really busy slide, but the 3 boxes down the right side are just copies of the previous slides you just saw. I just brought them over here to make it easier to see where the numbers were coming from. And what I'm showing, and to the person's question, I'm lumping all this into to a single indirect rate, of which fringe is part of that. Yeah, okay. Let me go through this and I'll try to come back and see if I can explain my way out of this. So this is coming up with our, if you will, our indirect cost budget for next year. And again, it could be the next fiscal year, it could be the next calendar year. So indirect labor, this is the amount of time we're paying our employees when they're not working on projects. we're paying them because we employ them, but we're not able to charge their time, if you will, to a customer, to a client. And that was $49.7. And if you go back, that was the discounted amount. Remember, we said our employees were going to earn $55,000 in salaries while working on indirect, but then we had to discount it by the amount of paid absence, and that gave us the $49.7. The value of the paid absence was the first thing we calculated. That's $16,354. Payroll taxes, paid employee benefits were the two numbers we just derived. And then all the rest of the numbers here are budget, based on our budget or our obligations. So for example, rent, we've got a lease for $1,000 a month, so we can put in $12,000 for rent. I'm assuming a budget of IRAD for $13,000. I've got that in here. And by the way, very artificially in here because it's shown in a way that it would not be labor related, would not be tied back to the labor. It's separate from that. So it's a bit of an oddity, but I wanted to show it for people's benefit who wanted to have IR&D built into this. Telecommunications, $500 a month. Office supplies, $500 a month. $10,000 indirect budget for travel. A couple $100 a month for legal and accounting. We have a depreciation schedule that shows about $5,000 a year in equipment, furniture write-off, and a key person insurance on the president, $200 a month. So our entire cost of being in business next year is a grand total of about $151,600. Now, if you take that indirect cost, that indirect budget of $151,580, divide it by our discounted direct labor. This is the amount of labor we're going to charge clients for during the fiscal year. And we got $103,937 by starting with our estimate of $115,000 in salaries to be paid while working on direct projects. We discounted it by the paid absence, and that gave us the $103,937. So do the math, 151.6 by 104, and you get 145.8%. Congratulations, you have derived your indirect rate for your small business for the coming fiscal year. What this says is when we bill a customer $1,000 in direct labor, we will bill them another $1,458 for our cost of being in business, our indirect rate. And if we do that consistently, then by the time the end of the fiscal year rolls around and we billed exactly $104,000 in direct labor, we will collect exactly $151,600 in indirect costs, and it covers all of the categories shown here to the penny. Now, does anyone see anywhere in there where we might be off by a few pennies? Well, of course, everywhere. I mean, a lot of this stuff was, we're assuming amount of sick leave or amount of time people are going to be sick. We're assuming the federal government won't change the Social Security tax. We're assuming the state of Arkansas won't change the unemployment rate. We're assuming that we're going to travel $10,000 worth in the year rather than being a pandemic year where people didn't travel. So there's assumptions everywhere, but it's a starting point. It's a number, an indirect rate that we can use in our estimates. And the beauty of it, in my opinion, is once you start using it and you've done all these calculations, now when things change and the boss decides on a Tuesday that she wants to add a 11th holiday for everybody, we know that's going to change our indirect rate, and we can rerun this calculation and see how that affects our indirect rate. So it's really the beauty is doing this the first time, getting it kind of under your belt, and starting to use it and realizing you're going to be revising it and improving it constantly going forward. So let's show how we would plug that. Well, let me real quickly, if I can, to the question about Fringe. I think, and what you've got here, the numbers that you would want to pull into Fringe are paid absence and then the employer paid payroll taxes. So you got about, about 30,500 looks like in those costs. Something you can do is take what I'm showing here as a single column for indirect. You can actually break that out into multiple columns. So you could have a fringe column, an other overhead column, and a G&A column, and show these numbers in whichever column they belong. Those two numbers would be under the fringe column, and then you would again total to about 30,500, and that would be the basis for your calculation for your fringe rate. All right, so let's use this 145.8% now in our cost proposal. Now we've got that number, but we've got a couple of other things we've got to do in the cost proposal. One is, how much labor do we need on this SBIR project? Well, again, it's the old eating the elephant thing. It's easier, in my opinion, to estimate the number of hours that each employee will work on each task than it is just trying to come up with a total labor budget. So instead, we're going to ask in task one, how many hours will Smith put into task one? How many hours will Garcia put into task one? How many hours will Zukai put into task one? Task two, how many hours will each employee put into that? And that way we come up with a number of hours by task. And it also allows us to sum across the rows and get the total number of hours per employee. So Smith gets 225 hours spread across the 4 tasks, Garcia's 400, Zukai 350. There's the hourly labor rates, and we sum it up and we get about $23,000 for our direct labor. Then I'm showing if we had some materials we needed for this project. Again, you break it down by component parts, kind of quantities, get an estimated price, and sum it up, and we get about $5,900 for that. Now we can take all this information and do our cost proposal. So there's our direct labor at $23,000. There's our direct materials at $5,900. I'm assuming a subcontract at the university of about $12,000. And here's indirect cost at our rate that we just calculated, 145.8%. Take that rate, and remember we calculated it as a percentage of direct labor. Not all direct costs, just direct labor. So we multiply the 145.8% times only the 22,975 number, and that gives us about 33,500 for our indirect cost. Sum it up, we're at about $74,000. Add 7% on top of that, so another 5,200. We are prepared to bid this project at 79,603, and there is not a single number in this proposal, cost proposal, that we can't justify with a straight face under negotiations. All right. All right. Busy slide. In the interest of time, we're coming down to the home stretch here. I'm not going to spend a lot of time on this. Top one, I want you to be aware NIH does have some salary caps. Doesn't matter how much you want to pay your employees, doesn't matter what BLS.gov says they're worth, they're not willing to pay more than $199, an annual rate equivalent of $199 for an employee. NSF is real stingy about consultants. They're only willing to pay $1,000 a day for a consultant. But in my opinion, that only includes the consultant's direct labor rate. It doesn't include their indirect costs, which could be added on to that. And the bottom bullet, very important. I mean, spreadsheets, Excel's going to make this a whole lot easier and make it a lot easier to do what-if analysis if you use those spreadsheets, and if you're just doing this on the back of an envelope and having to do a lot of erasing. Now, wouldn't it be nice if maybe, I don't know, 7 or 8 years ago, I was teaching this workshop in Stillwater, Oklahoma, and wouldn't it be nice if one of the attendees that night went back to her hotel room and put this entire derivation process here on Excel? And wouldn't it be nice if she came back to the class the next day and did this? And, you know, feel free to hand it out to anybody that might want it in the future. You know, feel free to share it. Wouldn't that be nice? Yeah, it didn't happen, so sorry. No, actually it did happen, and it was Stillwater, Oklahoma. I think it was longer ago than that, but it all runs together after a while. But the point is, I have her work, which was putting this and all of the preceding worksheets here on an Excel spreadsheet. If you would like that as a template to derive your indirect rate, then you've got my email address on the front of these materials. Send me an email. Tell me you want the template, the indirect rate template, and I'll send you an email with it attached, a return email with that attached. So, you can do all this yourself if you want to. There's nothing magical. It's just tedious to do it on Excel. She's already done it. You'll obviously have to modify for what that you're representing, but it's a good starting point already. Point here is that some agencies, and unfortunately it's not all agencies, some agencies are not including all of your outside costs in the 33% maximum subcontracting, and others are. And I'll leave it to you if that's an issue with your project. If you're getting close to 33% on how much you're subcontracting, you might want to take a close look at this, because agencies calculate what goes into the 33% maximum subcontract differently. And some are a lot more Scroogey about it than Scroogey, is that a real word? Are a lot more Scrooge-like than others. The military is particularly Scroogey. And this actually shows you how the military and NASA would go about this. And 145.8% rate that I showed you. And I feel your pain. I think I can make you feel better, though. So let me get down to that. So there's that 145.8%. Would you feel better if I could get that rate down to like 117%? Would that make you feel better? Okay, so you're feeling better, but you're still not feeling great. What if I could get that rate down to about 82%? And you're going, yeah, that sounds a lot better. I mean, that doesn't sound like you're gouging the government. It sounds like you're tightening the belt. You're being more conscientious on your accounting and your budgets. And yeah, that sounds better. Okay. Well, and actually, if you want, I could actually probably get this down to a G&A rate that's probably not more than like 40%. Sound good? Okay. Well, I'm glad you feel better, because all these numbers I'm throwing at you, 145.8, 17.6, 81.8, they're all based on the same numbers. I'm not cutting my budget at all. I'm not reducing my indirect costs at all. I'm just expressing my indirect rate differently to make you feel better. You feel better? I'm glad. Okay. So what did I do? Well, 145.8, you saw how that was derived, and that's as a percentage of direct labor. Well, see, that makes it look bigger as a percentage, because it's only a percentage of direct labor. If we make it a percentage of all direct costs, not just direct labor, and in my assumption we had non-labor direct costs of 25K, that got us down to a mere 117.6%. And then I was further able to drive it down to the 81.8% by reallocating some things that were in were in indirect, and I reallocated them to direct. And I've told you all along this morning, there are opportunities for taking direct costs and indirect costs and moving them from one category to the other by kind of redefining them and using different assumptions and so on. So it happens all the time. Now you're saying, what about this 40% you claim? Well, I already got you down to 81.8%. I could get you to 40%, because I would take, and I'm simplifying this, believe me, I could take that 81.8%, cut it into two rates. So there's a overhead rate and there's a G&A rate. And I bet you I could get the G&A rate below 40%. And you go, well, come on now, the reviewer's going to notice that you got two rates rather than one. I think you'd be surprised how little reviewers understand about this. and how much better they feel about two rates at 40% than a single rate at 80%. Sad, but true. By the way, here's how I got from the 117 to the 81%. How did I reallocate something from? There's an argument made by some that the fringe benefits we've been talking about all morning, some of those fringe benefits should be direct costs. And the argument is when I earn an hour of salary working on a webinar for Rebecca, it's not just the salary I earn, I actually earn some fringe benefits at the same time. So shouldn't the fringe benefits earned on salary when I'm doing a direct project, shouldn't that be a direct cost also? So there's some logic to it, and this is how you would do it with our little diagram. And I'm actually moving some of the fringe out of overhead and therefore out of indirect and moving into direct. Now you can't do that with all fringe because you've got some fringe on your support labor and you got some fringe on your G&A labor, but you can certainly reduce some of the indirect. And if you think about what you're doing, you're actually, this is a fraction, and what you're doing is you're moving the numerator one direction, making indirect smaller, and you're moving the denominator the other direction, your direct labor, your direct cost. So the percentage jumps dramatically, even with something as small as like a $25,000 reallocation. So that's how I was able to do that. Another example, basically the same thing. Here's exactly the same budget I showed you a few minutes ago of $79,000. All the numbers are the same, except that indirect rate is shown at 81.9% rather than 145.8%. And that is because I'm now showing it as a percentage of all direct costs, not just direct labor. And the bottom of the slide shows you what I mean by all direct costs. It's the direct labor, direct materials, and the subcontract. All right, let me, interest of time, we are right at the end of our session here. We did have some slides here about audits. I will just tell you that audits mean different things for different agencies. With the grant agencies like NIH, DOE, they tend to be you having to hire an auditor to perform an audit, and they go through your finances for that particular contract or grant with that agency, or you can have them do the entire company if you want. With NSF, they really don't do much in the way of audits. And with the military and the other contract agencies like NASA, they tend to use a government auditor, meaning the government hires them, or excuse me, they're a government employee, and they perform audits. And the one that does most of this is called, as the bottom of the slide here, DCAA, Defense Contract Auditing Agency. And they can perform all sorts of audits, a whole variety of audits at the request of your contracting officer. And let's just say if we're dealing with phase one, there's a real slim chance that you will deal with an auditor if you're just dealing with phase one. Phase two, it tends to be a different story just because of the larger sums of money that are involved. But in phase one, you shouldn't have to worry too much about the auditors. But more slides in here for those of you that are concerned about going to phase two, and or those of you that are in phase twos. Again, some more slides about what's involved there. But excuse me, why don't I pause here? Not hearing you, Rebecca.
Oh, okay. Yes, you cut out on my end, so I wasn't sure. We do have some questions. Do you want me to go ahead and start those? Okay, so the first question asks,
there you go.
Okay, if we choose to use the safe rate, like with NSF's 50% of direct labor, do we still need this level of breakdown that you were showing earlier? Or is there any drawback if that person feels he can just stay under the safe rate to not having a full breakdown?
Okay, interesting question. And we could talk a lot about this, and so I'll try to give you a short version. What they mean by safe rate is, for other people, what a safe rate means, if you ask for this rate or lower for your indirect rate, the agency won't bug you about it. They'll let you off and just let you have it. And I always ask people, why do you think they're allowing you that rate? Why do you think they're just going to give it to you without any negotiation? And the answer is because they know it is so cheap that it's not covering your costs and they're getting a bargain. And so they're not going to require any negotiation because they're getting a bargain out of you. So you're cheating yourself if you take the safe rate, number one. Number two, if you don't know what your rate truly is, you don't know how much that safe rate is hurting you. If, for example, if what we did in our exercise just now was your company and your rate is actually 145.8%, and you're contemplating taking a safe rate of 50%, you can see how badly that safe rate is going to cheat you and how much money you're going to lose in a phase one. Third point I'll make to you, I had a NSF client very recently be notified of award. She had used the 50% safe rate that you're talking about. The NSF grant administrator came back and said, no, I'm not going to give you the 50% safe rate. I'm only going to give you the 10% rate. Now, you have you're given a choice in the NSF solicitation. One is this 50% safe rate, 50% of direct costs. The alternative is you can ask for a 10% of all direct cost rate, although they only give it to you on the first 25,000 of subcontracts. But the point is, on a phase one, her true costs were, like 80%. She was being given 10%. She was being cheated badly. And I wanted her to be more assertive in the negotiation with NSF. She chose to not do so because she didn't want to risk losing the grant. But I guess what I'm saying is I'm concerned about safe rates because they tend to be too low for you to break even. You're going to lose money. That puts your company at risk of, if not failure, at least hurting and starvation. And it frankly POs me that government negotiators are trying to whittle down small companies to these rates when they should be helping you build a viable business and go hire people and diversify the economy and improve the economy of this country relative to our adversaries and the rest of the international community. But they seem to be real prone to just looking at doing cheap stuff. So I don't think doing what we're doing today gets washed away by just taking the 50% safe rate. And I really implore you to look real hard at what we've done today as, don't I want to do this? And don't I want to ask for a rate of 62% or 79% or whatever it is, that is truly what I think the rate is that I deserve and need to sustain my company, as opposed to just taking this arbitrary 50% safe rate.
Thanks. Thank you, Jim. We have another question that asks, what are the government's rights to a company's patent?
Excuse me, if we're talking, get a drink here. Again, if we're talking about what you brought to the table, your pre-existing IP, they don't have rights. What they have a right to is if you invent something with their SBIR, STTR money, they have a right of free use, royalty-free use of that. They don't often exercise that right because they're smart enough to see it's better in many cases, rather than trying to exercise that right. Instead, they come back and contract with you to use that IP in some other application, or advance it to some further stage of development or something like that. So That's all they have a right to, is a right of free use of what you have done, or what you have invented with SBIR or STTR funding.
Okay, perfect. Thank you. Our next question asks, don't we have to have negotiated a rate with the agency and get it approved if our rate is over the safe rate, or if it's an accepted rate that the agency posts?
Well, again, you gotta read the language real careful, and then let's go back to my friends at NSF again. Again, I am a reviewer for NSF, and there are many things I love about NSF, and there's some things that really PO me, and this is one of the things that POs me. If you read that section about the safe rate, it's really carefully written to say you can only get a safe rate of 50%, or this little cheapo 50% of direct labor, or this little cheapo 10% of all direct costs without negotiation. Now, what does without negotiation mean? That means we'll give you that rate if you'll just accept it. Now, if you want a higher rate, you'll have to negotiate it. Well, fine. I've just shown you how to come up with a higher rate, or how to come up with the real rate. And if you come out with a rate that's 73%, put in 73%. And they say, well, it's higher than our 50%. And you say, yes, and I've derived my my rate. I estimated 73%. Let's negotiate. Now, my guess is they'll probably whittle you down from 73%, but I bet you'll get more than 50. Now, some people don't want to do that because they're afraid to negotiate. Well, again, guys, based on what you now know from this webinar, you could be drunk as a skunk, high as a kite, 3 limbs, your choice, which one's tied behind your back, and you fall into the room and you can negotiate with what you know now. You've got the knowledge, and that's what you need to be able to negotiate, is the knowledge. And the other part you got to do to negotiate is the willingness to take government on, if you will. Now, I will be the first to admit that there's stress related to that, and it's going to delay getting your phase 1 project, because, you know, as soon as you say negotiate, it's, oh my God, now we got to, you know, I got to set a time, you know, to negotiate. Yeah, but, you know, if enough people will do that, then at some point, these agencies go, gosh, I guess we need to increase our safe rate because everybody wants to negotiate. We're not getting these projects underway because everybody needs to negotiate. That's exactly what happened at NIH 4 or 5 years ago. The phase 2 rate, safe rate, if you will, at NIH was a crummy 25%, unless you wanted to negotiate. And so many people were not, thank God, were not willing to accept 25%, that NIH couldn't keep up with all the people who were in negotiations. So they raised the phase 2 safe rate to the same 40% rate that they've got on phase 1s. So again, it's, yeah, I understand the tension and the time issue, but there's that old issue, time is money. If you're willing to wait a little time, I think you can get a lot more money in your indirect rate.
Good advice. Thanks, Jim. We have another question that asks, you mentioned earlier that NSF does not allow equipment. Is that only equipment greater than 5,000, or would it include something smaller for an experiment that requires a prototype or a widget? Would that be allowable?
I think you can allow it because they are defining equipment as $5,000, and is it a 2-year life, 1-year life, or 2-year life? Can't remember what NSF has, but if you're coming in, let's say, with something that's $2,500, then you could ask for that. Just don't call it equipment in your technical proposal. Don't call it equipment. In your budget justification, don't call it equipment. Just put it under other direct costs, and there shouldn't be an issue with that.
Okay, that's helpful. This next one asks, how do you budget if you need to hire employees once you get the award, but you don't know their names yet?
Yeah, this is a tough one. If they're basically I don't know how you say this without sounding bad, but if we're talking routine employees, folks that have a skill set that is pretty commonly available, and it's not a real critical part of the research, then to be determined or to be hired is not such a big deal. But the other extreme is I've actually seen proposals where principal investigator to be determined. Well, that's not going to fly, because here's the person you're saying is going to be responsible for the overall conduct of this project and for its successful completion, and you don't even know who they are yet. That's the other extreme. So the closer the individual is to the PI role and having a specialized skill set, then the more you need to name them. Now, it can be a situation where you're saying, I know who it is, but they're working full-time somewhere else, so I can't say that they're an employee of mine. What you can put into that part of the proposal is this is a to-be-hired individual, that upon award of this SBIR contractor grant, this person has agreed to join our company at that time. Here's their bio. So you can still include a real name and a real person in that sort of scenario. But boy, if you've got a real critical skill set is required and not many people have it, and you haven't identified the person that's going to fill that role, that's a major gap in your proposal, and I think you're going to have to fill it before you're going to be very credible.
All right, makes sense. We have one last question, and it asks, how often have you seen businesses actually lose an award because they decide to negotiate and stick to their guns?
The one I know of, and this goes back a long ways, but and this was one of those where it was labor, the labor price. This guy was a PhD physicist, and he had been employed at a federal laboratory that pays pretty well and really highly regards PhD physicists. And so he had put himself in at a pretty handsome salary into his, it was actually a phase 2 budget. The agency that he submitted the phase 2 to them, that agency went to the Department of Labor in that state and said, kind of what's an unemployed PhD physicist worth? And the Department of Unemployment said, well, pretty much nothing, because they got no useful skills, and you can't teach them anything because they think you know it all. It was some sort of, and I'm obviously being smart ass about that, but it was basically real derogatory that they're not really worth much. So the Department of Labor said, I think they're worth $25 an hour or something like that. And the guy had put himself in at like 75. And so they got into negotiations, and he was so adamant that he was worth so much more than the agency would give him that he refused to take the phase 2, that he would just not put up his reputation, his ego, and his discipline against what they were going to give him on an hourly rate. So that's a case, and that's actually the employee the business making the decision. Have agencies ever walked away? I'm sure they have. I'm sure there are cases where things are just so disconnected between what the agency is willing to do and what the company wants that the agency just walks away. But I'm cynical about this, guys, I'll admit that, but I think there are times when the U.S. government takes advantage of small companies, small SBIR companies, by kind of threatening them with a take it or leave it attitude. And I think there are times when that's a bluff, because as I said earlier, by the time you get down to negotiating a budget, there were 10 companies that submitted proposals on this topic. All 10 proposals got reviewed. they discussed them. They picked out the 2 that are the best, and now they want to fund the 2 of you. They don't want to give up you after they put all that effort into it and have to go back and get one of the others. So you got some leverage there. Now, if you are submitting to AFWorks and the Air Force, and you are one of 400 companies getting a phase 1 this year, or excuse me, this funding cycle, and you want to play hardball, yeah, I could see them telling you to take a hike because, you know, there are hundreds of them. They're cookie cutter contracts with these little companies, and one of them doesn't want to play ball, fine, they're thrown out. So I guess there are instances where you're a commodity and you're not going to be very successful putting up an argument. But I'm going to venture to guess that there are far more situations that the company just backs off and accepts being mistreated because they don't want to jeopardize the award. I had one very recently. They were, let me see if I can paraphrase. They were basically given no indirect cost and no fee by a component of the military on a phase 1. And the company decided to go along with it because they're looking ahead to the phase 2 and feel that they will do better on the phase 2. You know, I've got a real issue with the military pulling that with a small business. And I think there's a real gamble whether the military is going to be any better when it gets to phase 2 than they were in phase 1. But I understand the company's logic, at least. I don't agree with it, but I understand their logic.
Thanks so much, Jim. That's really good insights. We don't have any other questions, so thank you so much for staying on late to answer those.
All right. Let me do real quick if I can, Rebecca. I wanted to go to that slide about, and I'll just bounce down to it here. Again, if you're an Arkansas-based firm, because this was a webinar sponsored by the SBTDC through the University of Arkansas. If you're an Arkansas company, I will do a free cost proposal review and or review your derivation of your indirect rate. And again, there's the availability of the one-on-one consultation that Rebecca's mentioned for next Thursday, when we could spend about 25 minutes going over whatever issues you might have relative to the cost proposal. And finally, if you do decide to hire an accountant to take care of this stuff, first of all, I think you're better off having attended today's webinar, because now you know some of this stuff. You'll know what the accountants are talking about. You'll know how to direct the accountants, but also make sure that who you hire as an accountant knows government accounting and knows your agency within government accounting, because somebody who really understands NIH government accounting is not going to be very helpful if you have a DoD contract. So try to find yourself an accountant that knows this stuff. We have like 3 CPAs in the country who we recommend people to, just because we know they do good work. They know SBIR. They know the game. Not that they're the only companies in the country that are good at this, but they're just ones that we have experience with and can recommend. But again, be real careful and make sure if you hire an accountant, that they really know government accounting and your agency government. And with that, Rebecca, I appreciate the opportunity, and it's been fun.
Yes, thanks so much, Jim. This was wonderful information. We already got some chat messages thanking you for the great webinar. So
thank you.
Thanks again. And of course, if you are interested, hope to see you next Thursday to reconnect through one-on-ones with Jim on your cost proposal. You'll be receiving a recording and slides if you haven't got those already within a couple of days. And I hope everyone has a great rest of your day and weekend. Thanks again, everyone.